March 15, 2019, 10:58 and 40 seconds a.m. The Investment Company Act of 1940. U14 LO1. Identify the legal requirements of investment companies. The first of the pooled investment vehicles we'll cover are investment companies. An investment company is a corporation or a trust through which investors may acquire an interest in large, diversified portfolios of securities by pooling their funds with other investors' funds. People often invest in investment companies because they believe a professional money manager should be able to outperform the average investor in the market. As with all investments, there are benefits and risks. This unit will close with a discussion of the benefits and risks for most of the pooled investments covered. Investment companies raise capital by selling shares to the public. Investment companies must abide by similar registration and prospectus requirements imposed by the Securities Act of 1933 on every other issuer. Investment companies are also subject to regulations regarding how their shares are sold to the public. The Investment Company Act of 1940 provides for SEC regulation of investment companies and their activities. Types of investment companies. The Investment Company Act of 1940 classifies investment companies into three broad types: face amount certificate companies, management investment companies, and unit investment trusts, UITs, which will be covered a bit later at LO7. Face amount certificate companies, FACC. A face amount certificate is a contract between an investor and an issuer in which the issuer guarantees payment of a stated or fixed sum to the investor at some set date in the future. In return for this future payment, the investor agrees to pay the issuer a set amount of money either as a lump sum or in periodic installments. The most important fact you need to know about this security is that it is one of the three types of investment companies listed in the Investment Company Act of 1940. Management investment companies. The most familiar type of investment company is the management investment company, which actively manages a securities portfolio to achieve a stated investment objective. A management investment company is either closed-end or open-end. Mutual funds are open-end investment companies. Initially, both closed-end and open-end companies sell shares to the public. The difference between them lies in the way they raise capital and how investors buy and sell their shares in the primary or secondary market. Take note. Open-end and closed-end investment companies have far more similarities than differences. One of these is the term net asset value per share, generally shown as NAV. This value is the result of the fund valuing all of its assets, the largest of which is the portfolio, subtracting its liabilities, and then dividing that by the number of shares outstanding. This NAV per share computation is critical to the purchase and 310 Unit 14 Types and Characteristics of Pooled Investments. S65_LM.IN 310 March 15, 2019 10:58 and 40 seconds a.m. Sale of open-end companies, and, as we'll see, has little relationship to the buying and selling price of closed-end funds. Test topic alert: it is important for you to know that the definition of investment company does not include holding companies. Example 1. Which of the following would not be considered an investment company under the Investment Company Act of 1940? A face amount certificate company. B. Unit investment trust. C. Management company. D.
D. Holding company. Answer. D. Holding companies are specifically excluded from the definition of investment company, so choice D is correct. The sale of investment companies, especially mutual funds, is highly regulated through the provisions of the Investment Company Act. Some of the testable regulations are: 1. Board of Directors. In
general, investment companies cannot have a board of directors that consists of more than 60% of persons who meet the definition of interested persons of the investment company. Take note: another way of stating that no more than 60% of the directors may be interested persons is to say that at least 40% must be non-interest, that is, outside directors. are individuals who have no connection to the fund other than a position on the board, and may be owning some shares of the fund as would any investor. Typically outside directors are academics or prominent community members. 2. Prohibited activities. Investment companies are prohibited from engaging in several activities. Investment companies may not purchase any security on margin, participate on a joint basis in any trading account in securities, i.e., an investment company cannot have a joint account with someone else, sell any security short, or acquire more than 3% of the outstanding voting securities of another investment company. There are exceptions to these prohibitions, but, for the purposes of the exam, you may disregard any exceptions. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 311. S65_LEM.INV 311 March 15, 2019 10:58 and 40 seconds AM. Example. 1. The Investment Company Act of 1940 prohibits registered open-end investment companies from engaging in any of the following practices except A. Issuing common stock, B. Selling short or purchasing securities for the company's portfolio on margin, C. Owning more than 3% of the outstanding voting securities of another investment company, D. Opening a joint account with another investment company. Answer. A. The one thing that all open-end investment companies must do is issue common stock. Choice A. That is the form of ownership. All of the other activities are prohibited. 3. Changes in investment policy. In order for an investment company's board to make fundamental investment policy changes, a majority vote of the outstanding voting stock is required. Examples of fundamental changes would include a change in subclassification, such as from an open-end to a closed-end company or from a diversified to a non-diversified company, deviation from any fundamental policy in its registration statement, including a change in investment objective, and changing the nature of its business so as to cease to be an investment company. In other words, because the investment company is supposed to function for the benefit of the shareholders, any of these changes would require the vote of a majority of the shareholders. For the size of investment companies, no registered investment company is permitted to make a public offering of securities unless it has a net worth of at least $100,000. 5. Investment advisory and underwriter contracts. A majority vote of the shareholders is required to approve the contract between the investment company and its investment advisor and the contract with its principal underwriter. These contracts must be in writing and provide that the contract precisely describes all compensation to be paid, will be approved at least annually by the board of directors or by majority vote of the shareholders if it is to be renewed after the first 2 years, and provides that it may be terminated at any time, without penalty, by the board of directors or by majority vote of the shareholders on not more than 60 days, written notice to the investment advisor. In addition, it is unlawful for any registered investment company to enter into or renew any contract with an investment advisor or principal underwriter unless the terms have been approved by majority vote of directors who are not parties to such contract as affiliated. 312 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INV 312 March 15, 2019 10:58 and 40 seconds AM. Persons, i.e., directors who are not affiliated with the advisor or the underwriter, who in the aggregate must comprise at least 40% of the directors. Take note. The effect of this final paragraph is that no advisory contract, whether initial or renewal, may take effect without approval of the non-interest members of the board. 6. Transactions of certain affiliated persons and underwriters. Those individuals who are affiliated with the investment company or its underwriter have certain restrictions when it comes to dealing with the fund. These individuals cannot sell any personally owned security to the fund except redeeming personally owned shares of the fund, like any other investor, borrow money from the fund, or purchase from that investment company any security other than the fund's shares. Test topic alert. An affiliated person is defined as any person directly or indirectly owning, controlling, or holding with power to vote, 5% or more of the outstanding shares of the investment company. An affiliated person also includes any person directly or indirectly controlling, controlled by, or under common control with the investment company or any officer, director, partner, or employee of the investment company. However, while technically considered an affiliated person, no person is deemed to be an interested person for purposes of the maximum percentage of interested persons on the board solely by reason of his being a member of the fund's board of directors or an owner of its securities. A person is deemed to be a control person when owning or controlling more than 25% of the outstanding shares. 7. Custodian. It is required that every registered investment company keeps its assets with a custodian. In most cases, that custodian is a bank, hence the common use of the term custodian bank.
Bank. Although the Act specifies certain financial requirements for that bank, it does not require that the bank have FDIC coverage. Alternatively, the investment company may use a broker-dealer that is a member firm of a national securities exchange. 8. Redemption of shares, mutual funds. Upon request of the investor,
the Investment Company Act of 1940 requires that the proceeds be sent in no more than 7 days. The investor receives the next computed NAV per share using the forward pricing principle, described at LO 3. 9. Periodic and other reports. All investment companies must file annual financial reports with the SEC. These reports contain an audited balance sheet and income statement. In addition, shareholders must be sent financial information semi-annually. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 313. S65_LEM.INT 313 March 15, 2019, 10:58 and 41 seconds a.m. Knowing what is prohibited and what is required is often tested on the exam. Here are 2 examples expressing ideas that are likely to be tested. Examples. 1. ABC is an FINRA member broker-dealer. Among other functions, it serves as the principal underwriter of the XYZ mutual fund. Which of the following transactions of ABC would be prohibited? A. ABC tenders, from its investment account, 500 shares of the XYZ mutual fund for redemption. B. ABC purchases, for its investment account, 500 shares of XYZ mutual fund. C. ABC purchases some securities directly from XYZ's portfolio. D. All of these. Answer. C. It would be a violation of the Investment Company Act of 1940 for any affiliated person, such as the principal underwriter, to purchase any security from an investment company other than shares of the fund itself. Investing in the fund's shares would be permitted, not prohibited. 2. Which of the following statements correctly expresses requirements under the Investment Company Act of 1940? I. A registered open-end investment company using a bank as custodian must choose one that has FDIC coverage. 2. If an affiliated person of a registered investment company wishes to borrow money from the fund, there must be at least 300% asset coverage. 3. No investment advisory contract may be entered into that does not provide for termination with no more than 60 days' notice in writing. 4. No registered investment company may acquire more than 3% of the shares of another investment company. A. 1 and 2. B. I and 4. C. 2 and 3. D. 3 and 4. Answer. D. The Investment Company Act of 1940 requires that all advisory contracts contain a provision that the contract may be terminated upon no more than 60 days' notice in writing. Choice 3. The Act prohibits any registered investment company from owning more than 3% of the shares of another investment company. Choice 4 making choice D the correct answer. There are no circumstances under which an affiliated person can borrow from the fund, and it is not a requirement that the custodian bank have FDIC insurance. 314 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INT 314 March 15, 2019, 10:58 and 41 seconds a.m. Capitalization of management investment companies. U14L02, compare the difference between the method of capitalization of open-end investment companies and closed-end investment companies. Open-end investment companies' initial capitalization. An open-end investment company, or mutual fund, does not specify the exact number of shares it intends to issue. It registers an open offering with the SEC. The open-end investment company can raise an unlimited amount of investment capital by continuously issuing new shares. As a consequence, investors in mutual funds are always purchasing a new issue, a primary offering with the money going to the issuer, the mutual fund. One other point is that open-end companies can only issue common stock. The money raised from the issuance of that common stock is then used by the portfolio managers to invest in securities meeting that fund's objectives. For example, a mutual fund seeking income would likely invest a substantial portion of its capital into bonds and/or preferred stock. Don't confuse the limitation on only issuing common stock to raise capital with what it can invest with that. Capital bond funds will use the proceeds from the sale of the common shares issued to buy bonds. Example: 1. An investor is always purchasing newly issued shares of common stock when investing in A. A closed-end investment company. B. An open-end investment company, mutual fund. C. A unit investment trust, UIT. D. A holding company. Answer: B. The unique characteristic of mutual funds is that they are capitalized by a continuous offering of new shares. Choice B. Whenever an investor adds to her portfolio, she is buying new shares of common stock issued by that fund. In a UIT, the investor is purchasing units, not shares. Test topic alert. Because mutual funds are a continuous new offering, the prospectus must be distributed to a prospective investor before or during any solicitation for sale. Closed-end investment companies' initial capitalization. As we stated, the primary difference between the two categories of management companies, closed-end and open-end, is the way in which they raise capital and subsequently trade. To raise capital, a closed-end investment company conducts a common stock offering. For the initial offering, the company registers a fixed number of shares with the SEC and offers them to the public for a limited time through an underwriting group in a manner the same as any corporate stock offering. The fund's capitalization is fixed unless an additional public offering is made at a later time. Closed-end investment companies can also issue bonds and preferred stock. Therefore, the capital structure of a closed-end company can resemble that of any other corporation: common stock, preferred stock, and bonds. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 315. S65_LEM.INF 315 March 15, 2019, 10:58 and 41 seconds a.m. Pricing of management investment companies. U14L03, identify the difference in pricing between open-end and closed-end investment companies. Closed-end investment companies are commonly known as publicly traded funds. After the stock is distributed, anyone can buy or sell shares in the secondary market, either on an exchange or over-the-counter, OTC. Supply and demand determine the bid price, price at which an investor can sell, and the ask price, price at which an investor can buy. Closed-end fund shares usually trade at a premium or discount to the share's NAV. Test topic alert. Please remember the following points. 1. Closed-end investment companies trade based upon supply and demand for their shares. As a result, their buying and selling price does not have a direct relationship to the NAV of the shares. Put another way, the market price of a closed-end fund is independent of the fund's NAV. 2. Country funds are funds that concentrate their investments in the securities of companies domiciled in foreign countries. Well-known examples are the Korea Fund, the New Germany Fund, and the Mexico Fund. These country funds are generally organized as closed-end, rather than open-end, companies because it is often difficult to liquidate the foreign securities to get their value into the United States. When it comes to open-end investment companies, mutual funds, any person who wants to invest in a company buys shares directly from the company or its underwriters, or a broker-dealer with a selling agreement, at the public offering price, POP. A mutual fund's POP is the NAV per share, plus any applicable sales charges. A mutual fund's NAV is calculated daily by deducting the fund's liabilities from its total assets. NAV per share is calculated by dividing the fund's NAV by the number of shares outstanding. An open-end investment company sells redeemable securities. When an investor sells shares, the company redeems them at their NAV. For each share an investor redeems, the company sends the investor money for the investor's proportionate share of the company's net assets. Therefore, a mutual fund's capital shrinks when investors redeem shares. Each investor's share in the fund's performance is based on the number of shares owned. Mutual fund shares may be purchased in either full or fractional units, unlike stock, which may be purchased in full units only. Because mutual fund shares can be fractional, the investor. 316 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.IN 316 March 15, 2019, 10:58 and 41 seconds a.m. Can think in terms of dollars rather than number of shares owned. Because closed-end funds trade like any other corporate stock, fractional shares are not available. Open-end, closed-end. Capitalization unlimited, continuous offering of shares, fixed, single offering of shares. Issues, common stock only, no debt securities, may issue, common stock, preferred stock, debt securities. Shares, full or fractional, full only. Offering and trading sold and redeemed by fund only, continuous primary offering. Must redeem shares. Initial primary offering. Secondary trading OTC or on an exchange does not redeem shares. Pricing NAV plus sales charge selling price determined by formula in the prospectus. The price can never be below the NAV. Current market value plus commission price determined by supply and demand, so it can be above, below, or the same as the NAV. Test topic alert. We said earlier that closed-end funds also compute NAV, however, because their price is determined by supply and demand and, as a consequence, may be more than, the same as, or less than the NAV, it does not have the relevance that it does with open-end funds. Therefore, instead of daily computation, it is generally only done once per week. Forward pricing. Open-end investment companies, mutual funds, must compute their net asset value per share, NAV, at least once per day. Very few compute more than that, as of the close of the markets, generally 4 p.m. Eastern Time. Price determination for purchases and sales is based upon the forward pricing principle. That is, whenever an order, whether to purchase or redeem shares, is received, the price is based upon the next computed NAV per share. For example, any order received and time-stamped prior to 4 p.m. Eastern Time will be executed at the price computed as of that day's market close. If the order is received at 4 p.m. or later, it will be executed based upon the NAV computed as of 4 p.m. the next business day. Example. If NAPCO mutual fund shares are $15 per share, a $100 investment by 6.667 shares, $100/$15 equals 6.667. An investment company's portfolio is elastic. Money is simultaneously invested into the fund and paid out when shares are redeemed. The mutual fund portfolio's value and holdings fluctuate as money is invested or shares redeemed, and as the value of the securities held by the portfolio rises and falls. The investor's account value fluctuates proportionately with the mutual fund portfolio's value. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 317. S65_LEM.IN 317 March 15, 2019, 10:58 and 41 seconds a.m. Example. 1. Daniela has a number of investment company products within her retirement portfolio. One of these investments trades on an exchange and may trade at a premium or discount to its net asset value. These features are most likely found in what type of investment? A. Closed-end investment company. B. Unit investment trust. C. Open-end investment company. D. Face amount certificate company. Answer: A. A closed-end investment company, closed-end fund, or CEF. Choice A is a type of investment company whose shares trade in the secondary market. It is critical to remember for the exam that the price of a closed-end company is based on supply and demand and, therefore, can sell at, above, or below the fund's NAV. Mutual fund share classes and loads. U14L04. Contrast the different mutual fund share classes and how that relates to the different types of loads charged to fund investors. FINRA prohibits its members who underwrite fund shares from assessing sales charges in excess of 8.5% of the POP on the purchase of open-end investment company shares. The actual schedule of sales charges is specified in the prospectus. Sales loads, management fees, and operating expenses reduce an investor's returns because they diminish the amount of money invested in a fund. Historically, mutual funds have charged front-end loads of up to 8.5% of the money invested, the POP. Alternatively, funds may charge a back-end load when funds are withdrawn. Some funds charge ongoing fees under Section 12B1 of the Investment Company Act of 1940. These funds deduct annual fees to pay for marketing and distribution costs. A fund's expense ratio expresses the management fees and operating expenses as a percentage of the fund's net assets. All mutual funds, load and no load, have expense ratios. The expense ratio is calculated by dividing annual operating expenses by the average dollar value of the fund's assets under management. The sales charge is not considered an expense when calculating a fund's expense ratio. Example: an expense ratio of 1.72% means that the fund spends $1.72 per year for every $100 of invested assets. Typically, more aggressive funds have higher expense ratios. Example: an aggressive growth fund's expense ratio is usually higher than that of an AAA bond fund because more trading occurs in the growth fund's portfolio. 318 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INV 318 March 15, 2019, 10:58 and 41 seconds a.m. Closed-end funds. Closed-end funds do not carry sales charges. An investor pays a brokerage commission in an agency transaction or pays a markup or markdown in a principal transaction. Open-end funds. All sales commissions are paid from the sales charges collected. Sales charges include commissions for the managing underwriter, broker-dealers, and their agents who sell the fund, as well as all expenses incurred in communications with the public. The sales charge of a mutual fund is stated as a percentage of the POP per share. Mutual fund distributors use three different methods to collect the fees for the sale of shares. Front-end loads, difference between POP and net NAV. Back-end loads, contingent deferred sales loads. 12B1 fees, asset-based fees, technically not a sales charge. Front-end loads. Front-end sales loads are reflected in a fund's POP. The charges are added to the NAV at the time an investor buys shares. They are frequently referred to as Class A shares and have lower operating expense ratios than other classes. Back-end loads. Back-end sales load, also called a contingent deferred sales charge or load, CDSC, is charged at the time an investor redeems mutual fund shares. The sales load, a declining percentage charge that is reduced annually, for instance, 8% the first year, 7% the second, 6% the third, and so forth, is applied to the proceeds of any shares sold in that year. The back-end load is usually structured so that it drops to zero after 6 to 8 years, at which time they are converted to Class A shares with their lower operating expense ratios. They are frequently referred to as Class B shares. 12B1 asset-based fees. Mutual funds cannot act as distributors for their own fund shares except under Section 12B1 of the Investment Company Act of 1940. This provision permits a mutual fund to collect a fee for promotion or sales-related activities in connection with the distribution of its shares. The fee is determined as a percentage of the fund's average total NAV during the year. The fee is disclosed in the fund's prospectus. The percentage of net assets charged must be reasonable, typically 0.5% of net assets. This annual fee cannot exceed 0.75% of net assets, and the fee must reflect the anticipated level of distribution services. If the fee exceeds 0.25%, the fund cannot use the term no load. In order to charge a 12b-1 fee, there are several specific requirements in the law. There must be a written plan, and this written plan must meet the following requirements. The plan has been approved initially by a vote of at least a majority of the outstanding voting securities of the investment company. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 319. S65_LEM.INV 319 March 15, 2019, 10:58 and 41 seconds a.m. The plan, together with any related agreements, has been approved initially and reapproved at least annually by a vote of the board of directors of the company, and of the directors who are not interested persons of the company, the outside directors. The plan may be terminated at any time by a vote of the majority of the members of the board of directors of the company who are not interested persons of the company, or by a vote of the majority of the shareholders of the company. Classes of fund shares. Mutual funds may offer several classes of shares to allow investors to select how they pay the sales charges. The following is a typical method by which firms may classify fund shares by fee type: Class A, B, and C shares. Class A shares, front-end load, investors pay the charge at the time of purchase. Class B shares, back-end load, declines over time, so investors pay the charge at redemption. Class C shares, level load, no sales charge to purchase, generally a 1% CDSC for 1 year, with a continuous 12b-1 charge. The class of shares determines the type of sales charge as well as operating expenses, with Class A having lower costs, usually a low or no 12b-1 fee, than Class B and Class C shares. All other rights associated with mutual fund ownership remain the same across each class. Take note. In recent years, a number of other share classes have emerged. As of the printing of this text, the only ones we are aware of possibly appearing on the exam are the following. Class 1 shares, which would be sold only to institutional investors, hence the letter I, and usually have lower fees and expenses. Class or shares, which would be sold only to participants in retirement plans, such as a 401k, and have no front-end or back-end load, but may have a 12b-1 fee. Reductions in sales charges. There are two ways that an investor can take advantage of reduced sales charges available on Class A shares for larger purchases. Breakpoints, a scale of declining sales charges based on the amount invested. Rights of accumulation permits an investor to aggregate shares owned in related accounts in some or all funds in the fund family to reach a breakpoint discount with no time limit. Breakpoints. The schedule of discounts a mutual fund offers is called the fund's breakpoints. Breakpoints are available to any person. For a breakpoint qualification, the term any person includes married couples, parents and their minor children, and corporations. Investment clubs or associations formed for the purpose of investing do not qualify for breakpoints. 320 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INV 320 March 15, 2019, 10:58 and 42 seconds a.m. Figure 14.1, Sample Breakpoint Schedule. Purchase Amount Sales Charge. $0 minus $24, 999 6.5%. $25, 000 minus $49, 999 5.5%. $50, 000 minus $99, 999 5%. $100, 000 minus $249, 999 3%. $250, 000 minus $499, 999 2%. $500, 000 minus $999, 999 1%. $1 million plus 0%. An An investor can qualify for breakpoints in several ways. A large lump sum investment is one method. Mutual funds offer additional incentives for an investor to continue to invest and qualify for breakpoints through a letter of intent. Breakpoint sales. Both state and federal regulators prohibit registered personnel from making higher commissions by selling investment company shares in a dollar amount just below the point at which the sales charge is reduced. This is known as a breakpoint sale, and this practice is considered contrary to just and equitable principles of trade. For example, using the above chart, if an order for $24,000 was taken without indicating to the investor that an additional $1,000 would save $250 in sales charges, 1% reduction on $25,000 would likely be considered a violation. Take note. Although not specifically listed as a violation, regulators scrutinize large purchases of Class B shares. A purchase large enough to reach a significant Class A share breakpoint results in a low enough sales charge that, in just a few years, the lower operating expenses of the Class A shares will more than make up the difference in front-end cost. In practice, very few firms will accept an order for Class B shares in excess of $100,000, particularly if the investor intends to maintain the position for a number of years. Letter of Intent, LOI. A person who plans to invest more money with the same mutual fund company may decrease overall sales charges by signing a letter of intent, LOI. In the LOI, the investor informs the investment company that he intends to invest the additional funds necessary to reach the breakpoint within 13 months. The LOI is a one-sided contract binding on the fund only. The customer must complete the intended investment to qualify for the reduced sales charge. The fund holds the extra shares purchased as a result of the reduced sales charge in escrow. If the customer deposits sufficient money to complete the LOI, he receives the escrowed shares. Appreciation and reinvested dividends do not count toward the LOI. Unit 14. Unit 14 Types and Characteristics of Pooled Investments, 321. S65_LEM.N 321 March 15, 2019, 10:58 and 42 seconds a.m. Example. Using the sample breakpoint schedule previously listed, a customer investing $20,000 is under the $25,000 breakpoint. The customer might sign a LOI promising an amount that will qualify for the breakpoint within 13 months from the date of the letter. An additional $5,000 invested in the fund within 13 months qualifies the customer for the reduced sales charge. Each deposit is charged the reduced sales charge at the time of purchase. If the customer has not completed the investment within 13 months, he will be given the choice of sending a check for the difference in sales charges or cashing in escrowed shares to pay the difference. Backdating the letter. A fund often permits a customer to sign an LOI as late as 90 days after an initial purchase. The LOI may be backdated by up to 90 days to include prior purchases, but may not cover more than 13 months in total. This means that if the customer signs the LOI after 60 days, he has 11 months to complete the letter. Example. 1. When discussing investment companies, the term sales load most commonly refers to the fund's sales charge, expressed as a percentage of the NAV. B. The fund's sales charge, expressed as a percentage of the public offering price. C. The commission earned by the broker-dealer making the sale. D. The 12B1 fee. Answer. B. Class A shares of an open-end investment company, mutual fund, have a front-end sales charge, or sales load, which is computed as a percentage of the POP, choice B. That is, if the fund's POP is $10 and the NAV is $9.50, the 50-cent sales charge is 5% of the $10 offering price. In general, most of the sales load is paid to the broker-dealer making the sale as compensation. The 12B1 fee is never referred to as a sales load because it is not related to the sale of shares. 2. Barbara wishes to invest in the Capco Growth Fund, an open-end investment company. She expects to hold the shares for at least 10 years. If she purchases Capco's Class A shares, each of these would be a way for her to receive a reduction on the sales charge except a single investment that reaches a breakpoint. B. Joining together with her sister to make a purchase at a breakpoint level. C. Signing a letter of intent. D. Benefiting from the right of accumulation. Answer: B. Reaching a breakpoint is the way in which investors can receive a break on the sales load charged when purchasing Class A shares. Purchases may be combined with spouses and dependent children, but 322 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INV 322 March 15, 2019, 10:58 and 42 seconds a.m. Not other family members, such as siblings, making the exception here. Choice B. The three ways to reach a breakpoint are: 1. A lump sum purchase. 2. Using a LOI granting 13 months to reach the breakpoint, or 3. Taking advantage of rights of accumulation, no time limit. 3. An investor who initially makes a small investment in a mutual fund may have the advantage of a lower sales charge on investments made over a 13-month period through A. A breakpoint letter. B. A Class A letter. C. A letter of intent. D. A sponsor's letter. Answer: C. Investors who sign a LOI. Choice C. Stating they will invest a specified amount over a 13-month period are eligible for a reduced sales load if they invest enough to reach the breakpoint within that time. Breakpoints entitle investors to reduced sales charges. Private funds. U14LO5. Identify the characteristics of private funds and venture capital funds. In Part 1, we discussed the exemption from registration offered under both state and federal law for those who are investment advisors to private funds and venture capital funds. At that time, we explained the legal definitions, and at this point, we're going to discuss the primary characteristics of these two. Private funds, generally referred to as private equity funds, limit their ownership so as not to be considered investment companies. Remember, as a 3C1 fund, there can be no more than 100 investors and, under state law, all of them must be qualified clients. If exempt under the 3C7 provision, all investors must be qualified purchasers and the fund is limited to a maximum of 1,999 investors. Most almost never approach anywhere near that number. Most private funds are organized as partnerships rather than corporations. One special kind of private fund is the hedge fund, and that will be covered in the next unit. One difference between hedge funds and the other private funds is the anticipated holding period of the investments. Hedge funds tend to take a more active trading role where their positions are traded actively over a short time period. Conversely, private funds generally hold their investments for the long run. Private funds can be separated into two different categories: those which make direct investment and those which make portfolio investments. What is the difference? In the first case, the funds have a 10% or greater voting interest in an operating company, one that is actually in operations, with the goal of influencing management and operations. The latter case, the fund does not acquire a control position and builds a portfolio that may be stock, bonds, derivatives, or any combination of these. Unit 14. Unit 14 Types and Characteristics of Pooled Investments, 323. S65_LEM.INV 323 March 15, 2019, 10:58 and 42 seconds a.m. One specific type of private fund that is becoming increasingly more popular is the private liquidity fund. The SEC defines private liquidity funds as any private fund that seeks to generate income by investing in a portfolio of short-term obligations to maintain a stable net asset value, NAV, per unit or minimize principal volatility for investors. If that sounds like a money market mutual fund, MMF, it should. In 2014, a number of restrictions, such as requiring a floating NAV, probably not tested, were placed on certain money market funds. In order to avoid those, the industry developed these private funds, which, being exempt from SEC registration, are also exempt from those restrictions. Because they are unregistered, less information is publicly available about these funds compared to a traditional MMF that reports its holdings on a monthly basis. Venture capital (VC) funds are also generally organized as limited partnerships where the investment decisions are made by the general partner with the capital coming from the limited partners, LPs. Those LPs can be wealthy individuals, pension and endowment funds, and even hedge funds. VC funds look for young, promising companies with an expectation of high returns in exchange for the high risk. Unlike private equity funds, it's more typical that venture capital fund investments are made in businesses that are not yet fully operational. The funding, and sometimes management guidance, provided has the goal of developing an exit strategy in 10 years or less. One common characteristic of private equity and venture capital funds is a compensation to the fund manager. Typically, the annual management fee is 2% of committed capital plus 20% of the profits when the business is sold. This is usually referred to as the carried interest. Example: 1. One of your friends is an entrepreneur who is looking for a way to raise capital for her fledgling business. Because the enterprise has no operating history, it is most likely that her best bet would be to approach A. A hedge fund, B. A mutual fund, C. A private equity fund, D. A venture capital fund. Answer: D. When the business is in the pre-operating stage, it is of most interest to venture capitalists. Choice D. Private equity funds, including hedge funds, invariably invest in going concerns, and mutual funds are almost always limited to purchasing securities that are marketable. Hedge funds. U14L06. Identify the structure, compensation arrangements, and suitability requirements of a hedge fund. These are a form of fund generally organized as a limited partnership with no more than 100 investors that does not have to register with the SEC, although the portfolio managers generally are required to register as investment advisors. Because there is no registration requirement, one of the differences between a mutual fund and a hedge fund is the hedge fund's lack of transparency. A mutual fund is offered via a prospectus filed with the SEC, while a hedge fund is offered via a private placement memorandum containing significantly less information. 324, Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.N 324, March 15, 2019, 10:58 and 42 seconds a.m. Hedge funds are free to adopt far riskier investment policies than those permitted to open and closed-end funds, such as arbitrage strategies and massive short positions during bearish markets. In addition, they may use leverage, borrowed money, and derivatives such as options and futures. Even though these risky techniques are employed, the primary aim of most hedge funds is to reduce volatility and risk while attempting to preserve capital and deliver positive returns under all market conditions. Another important factor is that management fees tend to be much higher than with other investments. Almost all hedge funds charge performance-based fees. The typical fee structure is known by the vernacular 2 and 20. Most funds take a 2% management fee and 20% of any profits. Fund compensation agreements may also contain a hurdle rate, where the incentive fee will only be paid if the fund return exceeds a set threshold return, example, 4%. Many hedge funds also require that investors maintain the investment for a minimum length of time, example, 1 year, and, to that extent, they can be considered illiquid. These requirements are known as lockup provisions. This provision provides that, during a certain initial period, an investor may not make a withdrawal from the fund. The investor's capital is locked up. Generally recognized as one way the manager of the hedge fund portfolio can have capital retained in the fund, it is also seen to be another factor adding to the unique risk of hedge funds, in this case, shares being illiquid for that specified length of time. Therefore, because of the higher risk, investment in these vehicles is limited to institutional clients and wealthy individuals, known as accredited investors, defined in Unit 1. Test Topic Alert. Most hedge funds are organized as limited partnerships with the portfolio managers investing along with the investors. As they say in the industry, they have skin in the game, so they have a greater motivation to succeed. The partnership is the issuer of the ownership units. Example: 1. Which type of investment company is most often organized as a limited partnership? A. Face amount certificate company. B. Exchange-traded fund. C. Hedge fund. D. Unit investment trust. Answer: C. For various legal reasons, mostly related to the need to avoid registration with the SEC, hedge funds are generally structured as limited partnership entities. Choice C, with the organizers invariably sinking their own funds into a few units. Hedge funds are indirectly available to ordinary investors through mutual funds called funds of hedge funds. Because hedge funds themselves have limited liquidity, purchasing a mutual fund of hedge funds offers not only diversification but also, in many, but not all cases, the liquidity of the mutual fund. Unit 14. Unit 14 Types and Characteristics of Pooled Investments, 325. S65_LEM.end 325, March 15, 2019, 10:58 and 42 seconds a.m. Test topic alert: you may be required to know what hedge funds and mutual funds have in common. Which of the following would you choose? A high degree of transparency, relatively low management costs of pooled investment with other investors, high liquidity. From what we've covered, you should have seen that hedge funds do not offer the transparency of mutual funds. The key to getting that point is that they are not registered with the SEC, so the disclosures that must be made are limited. The management fee structure for hedge funds is much higher than mutual funds, and, due to the lockup period, their liquidity is questionable. However, the common characteristic is that they are pooled investments. Unit Investment Trusts, UITs. U14L07, recall the special features of unit investment trusts. The third of the entities meeting the definition of an investment company under the Investment Company Act is the Unit Investment Trust, UIT. A UIT is an unmanaged investment company organized under a trust indenture. UITs do not have boards of directors, do not employ an investment advisor, and do not actively manage their own portfolios, trade securities. A unit investment trust issues only redeemable securities, known as units or shares of beneficial interest, each of which represents an undivided interest in a portfolio of specified securities. The trustees use the investors' money to purchase securities designed to meet the UIT's stated objective. Without an investment advisor, management, once compiled, the portfolio remains fixed. An example of a UIT is one solely invested in municipal bonds, where the trust liquidates after the final bond in the portfolio matures. There are also equity trusts, where, because stock doesn't mature, the portfolio is liquidated at a predetermined date and the proceeds distributed to unit holders or reinvested into a new trust at the investor's option. Under the Investment Company Act of 1940, the trustees must maintain secondary markets in the units, thus allowing unit holders the ability to redeem their units at NAV. Some ETFs, covered later in this unit, are organized as UITs and trade, as the name implies, on exchanges or the NASDAQ stock market. Take note now the following features of UITs. UITs are not actively managed. There is no board of directors or investment advisor. UIT shares, units, must be redeemed by the trust. UITs are investment companies as defined under the Investment Company Act of 1940. 326 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.end 326, March 15, 2019, 10:58 and 42 seconds a.m. Example. 1. Lewis owns an investment that is an unmanaged portfolio in which the money manager initially selects the securities to be included in the portfolio and then holds those securities until they mature or the investment portfolio terminates. This statement best describes which type of investment. A. Closed-end investment company. B. Face amount certificate company. C. Open-end investment company. D. Unit investment trust. Answer. D. A unit investment trust, UIT, is a type of investment company, choice D, which is generally unmanaged as the money manager initially selects the securities to be included in the portfolio and then holds those securities until they mature or the UIT terminates. Exchange-traded funds, ETF. U14L08, identify the distinguishing characteristics of exchange-traded funds, ETFs. An ETF registers with the SEC under the Investment Company Act of 1940 either as a unit investment trust, the UIT ETF, or as an open-end management company, an open-end ETF. In both cases, the ETF computes its net asset value daily, just as would any other UIT or open-end company. This type of fund generally invests in a specific index, such as the S&P 500. Any class of asset that has a published index around it and is liquid can be made into an ETF, so that there are ETFs for real estate and commodities as well as stocks and bonds. In this way, an ETF is similar to an index mutual fund. The difference is that the exchange-traded fund trades like a stock on an exchange or NASDAQ and, in this way, is similar to a closed-end investment company. The investor can take advantage of price changes that are due to the market, rather than just the underlying value of the stocks in the portfolio. Take note. Although, as stated, most ETFs are passive in that they are based on some index, in recent years, there has been a growth in actively traded ETFs where, instead of attempting to mirror an index, the managers select individual assets based upon expected performance. This concept will make more sense after you read Unit 20, which explains passive and active portfolio management styles. ETFs can be purchased on margin and sold short, covered in Unit 22, just like any other listed stock. This is another difference between ETFs and mutual funds. Expenses tend to be lower than those of mutual funds as well because all the advisor has to do is match up to the specified index, so the fees are minimal. In addition, there can be tax advantages to owning ETFs. However, because there are brokerage commissions on each trade, in and out, ETFs are generally not competitive with a no-load index fund for the small investor making regular periodic investments such as in a dollar cost averaging plan, described in Unit 20. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 327. S65_LEM.IN 327 March 15, 2019, 10:58 and 42 seconds a.m. Take note. There are now some U.S.-listed ETFs that are available for commission-free trading on certain select platforms. These are typically proprietary funds. These products can be bought and sold without traditional brokerage commissions for investors with certain accounts and subject to certain restrictions. For exam purposes, these are the exceptions rather than the rule. Many ETFs are legally classified as UITs with the rest as open-end companies, although those cannot be referred to as mutual funds because shares are not redeemable. Unlike the CEF, closed-end fund, where the market price will generally vary quite a bit from the NAV because those prices are determined by supply and demand, there are occasions where persistent small premiums and discounts arise in ETFs, but that is due to a structural inconsistency. Under normal circumstances, the premium and discount that arises between an ETF's NAV and its trading price at the end of the day is the result of late in the day market activity and will narrow at the opening on the following trading day. Example. 1. Which of the following is not touted as an advantage to purchasing ETFs instead of index mutual funds? A. Intraday trading. B. Typically lower expense ratios. C. Performance is generally better than the underlying index. D. Can be purchased on margin. Answer. C. One thing that neither of these products can claim is performance better than the underlying index. Choice C. Think about it. The index has no management fees. Even though the management fees on index funds are very low and those on ETFs generally lower than that, there are still expenses making it unlikely that their performance can beat that of the index. The fact that an investor can trade the ETF during the day instead of accepting whatever the next computed price is, can be a benefit for those who are trying to time the market. And, for those who wish to add the leverage of margin trading, explained more fully in Unit 22, that can only be done with ETFs, not index mutual funds. Real Estate Investment Trusts, REITs. U14L09, identify the unique features of REITs. A Real Estate Investment Trust, RIT, pronounced REIT, is a company that manages a portfolio of real estate investments to earn profits and/or income for its shareholders. Like many other pooled investment vehicles, REITs offer professional management and diversification. REITs are normally publicly traded and serve as a source of long-term financing for real estate projects. A REIT pools capital in a manner similar to an investment company. Shareholders receive dividends from investment income or capital gains distributions. REITs normally own commercial property, equity REITs. 328 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.End 328 March 15, 2019, 10:58 and 43 seconds a.m. Own mortgages on commercial property, mortgage REITs, or do both, hybrid REITs. REITs are organized as trusts in which investors buy and sell shares either on stock exchanges or in the over-the-counter market. They are not redeemable, as is the case with mutual funds or UITs. REITs enjoy a unique hybrid status for federal income tax purposes. A REIT shareholder generally is taxed only on dividends paid by the REIT and on gains upon the disposition of REIT shares. A REIT is a corporation for U.S. tax purposes, but because it receives a dividends paid deduction, the REIT generally is not subject to corporate tax if it distributes to its shareholders substantially all of its taxable income for each year. How much is substantially all? Under the guidelines of Subchapter M of the Internal Revenue Code, a REIT can avoid being taxed as a corporation by receiving 75% or more of its income from real estate and distributing 90% or more of its taxable income to its shareholders. Test Topic Alert. 5 important points to remember about REITs follow. An owner of REITs holds an undivided interest in a pool of real estate investments. REITs are liquid because they trade on exchanges and OTC. REITs are not investment companies, mutual funds. REITs offer dividends and gains to investors but do not flow through losses like limited partnerships and therefore are not considered direct participation programs, DPPs, Unit 17. The key numbers are 1. At least 75% of a REIT's assets must be represented by real estate assets such as real property or loans secured by real property, cash, and U.S. government securities. 2. At least 75% of the REIT's annual gross income must be for real estate-related income, such as rents from real property and interest on obligations secured by mortgages on real property. And 3. In order to qualify as a REIT, the REIT must distribute at least 90% of its taxable income. Take note. In recent years, there has been substantial growth in the number of non-traded REITs, limited liquidity. However, for exam purposes, assume the REIT is publicly traded unless the question states otherwise. Unit 14. Unit 14 Types and Characteristics of Pooled Investments, 329. S65_LEM.End 329 March 15, 2019, 10:58 and 43 seconds a.m. Benefits and risks of pooled investments. U14LO10 explain the benefits and risks of pooled investments in client portfolios. As you have seen, there are many different types of pooled investment vehicles. In general, they all share some important characteristics. Diversification. By pooling assets with many others, investors have the opportunity to own an interest in a far greater number and range of securities than available to almost any individual investor. Professional management. In almost all cases, someone with expertise, we hope, is minding the store. Even in the case of a UIT where there is no ongoing management, the initial portfolio is constructed by experts. The exam tends to focus on the most popular investments, such as mutual funds, so we will start with those. Mutual funds. What are the benefits of including mutual funds in a client's portfolio? Diversification. The old saying, "Don't put all of your eggs in one basket," certainly applies to the benefits of diversifying one's portfolio assets. Mutual funds are probably the easiest way to accomplish this. Although diversification may help to reduce risk, it will never completely eliminate it. It is possible to lose all or part of your investment. Professional management. Those individuals in charge of managing a mutual fund's portfolio must be registered as investment advisors with the SEC. The Investment Company Act of 1940 requires that they follow the stated objectives set forth in the prospectus. Taking into consideration prevailing market conditions and other factors, the mutual fund manager will decide when to buy or sell securities. Rare is the individual who has the time, knowledge, or resources to compete with these professionals. Choice of objectives. Whatever an investor's investment objectives are, there are mutual funds available to match. There are many shades of growth funds, from highly aggressive to very conservative, but all with the goal of growing the investment. The same is true with income funds, where the goal is to generate current income with varying degrees of risk from government bonds to high-yield bonds. If the objective is capital preservation, money market funds fit the bill, and then there are funds that combine objectives, such as growth and income funds. There are even specialized funds, sector funds, that concentrate at least 25% of their portfolio into specific industries or geographic areas, such as a biotech fund or a Southeast Asia fund. Convenience. With most mutual funds, buying and liquidating shares, changing reinvestment options, and getting information can be accomplished conveniently by going online at the fund's website, by calling a toll-free phone number, or by mail. Although a fund shareholder is relieved of the day-to-day tasks involved in researching, buying, and selling securities, an investor will still need to evaluate a mutual fund on the basis of investment goals and risk tolerance before making a purchase decision. Investors should always read the prospectus carefully before investing in any mutual fund. Liquidity. The Investment Company Act of 1940 requires that an open-end investment company stand ready to redeem shares at the next computed NAV per share. Payment must be made within 7 days of the redemption request. Although there may be a 330 Unit 14 types and characteristics of pooled investments. S65_LEM.IN 330 March 15, 2019, 10:58 and 43 seconds a.m. Redemption charge, and, of course, the value of the shares may be less than their cost. Liquidity is assured. Minimum initial investment. As mentioned previously, it doesn't take a great deal of wealth to get started investing in funds and, generally, once you are a shareholder, most funds permit additional investments of $100 or even less. Convenient tax information. Tax liabilities for an investor are simplified because each year, the fund distributes a 1099 form explaining taxability of distributions. Combination privilege. A mutual fund company frequently offers more than one fund and refers to these multiple offerings as its family of funds. An investor seeking a reduced sales charge may be allowed to combine separate investments in 2 or more funds within the same family to reach a breakpoint. Example. Joe Smith has invested $15,000 in the ACE Growth Fund for retirement and $10,000 in the ACE Income Fund for his children's education. The sponsor may view the 2 separate expenditures as one investment totaling $25,000 when calculating the sales charge. Exchanges within a family of funds. Many investment companies offer the exchange or conversion privilege within their families of funds. Exchange privileges allow an investor to convert an investment in one fund for an equal investment in another fund in the same family at NAV without incurring an additional sales charge. For example, someone who started investing when in their 30s or 40s by placing their money into an aggressive growth fund might consider moving into something more conservative when they reach their 50s. Once they hit their 60s and 70s, they would want to have a greater percentage of their money in income funds. By staying in the same family of funds and using the exchange or conversion privilege, all of these changes could be made free of sales loads. Take note. Any exchange of funds is considered a sale for tax purposes. Any gains or losses are fully reportable at the time of the exchange. Test topic alert. It is generally agreed that the number one advantage to investing in mutual funds is the diversification offered. In doing so, the client would be incurring the following risks. Even with the benefits offered by diversification and professional management, market prices do fluctuate. Equity funds have market risk, whereas bond funds may be subject to interest rate risk. Unlike an individual bond that ultimately repays principal at maturity, a bond fund doesn't have a maturity date. The only mutual fund that generally does not fluctuate in price is the money market fund, but there is a trade-off in lack of growth and low income. Not only that, but the income of a money market fund will vary, unlike that of a bank CD, which is fixed and FDIC insured. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 331. S65_LEM.INV 331 March 15, 2019, 10:58 and 43 seconds a.m. Fees and expenses. One must carefully analyze all of the costs involved. These include sales charges, 12B1 fees, and possible redemption fees. Management fees, probably the largest expense on an ongoing basis. The investor has no control over the manager's timing of purchases and sales, so tax efficiency could become an issue. Prospectuses will not contain all the costs that affect the net return on the fund. This is why it is important to compare net returns after all expenses, including taxes, to the investor. Other factors. When comparing funds with similar objectives, the investor should review information regarding funds. Services offered, costs, taxation, tenure of management, is the management team unproven or is there a long track record, and performance compared to an appropriate benchmark, see Unit 23. Net redemptions. It can sometimes happen, particularly during declining markets, that there is an excess of shareholder redemptions over new share purchases. This is known as net redemptions. When that occurs, the portfolio manager is put in the difficult position of having to decide which assets to liquidate when prices are falling. A fund suffering with net redemptions is probably not going to deliver your clients the performance they are seeking. Private funds. What are the benefits of including private funds in a client's portfolio? By investing before the company matures enough for a public offering, there is an opportunity for very large profits. Many private funds are structured so as to give the investors a say in the management and development of the company. Added diversification. Because these usually have a low correlation to the overall market, in doing so, the client would be incurring the following risks. Business risk. A high percentage of startups do not succeed and the investors lose most or all of their investment. Liquidity risk. There is rarely an opportunity to find a secondary market, and even when the company has a public offering, these investors' shares are likely to be restricted. Lack of transparency. Being unregistered securities, no regulatory body has reviewed the offering documents. 332 Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INV 332 March 15, 2019, 10:58 and 43 seconds a.m. Hedge funds. What are the benefits of including hedge funds in a client's portfolio? The design strategy of many hedge funds is to generate positive returns in both rising and falling markets. With a large variety of available investment styles, investors have a plethora of choices to assist them in meeting their objectives. As part of an asset allocation class, hedge funds may reduce overall portfolio risk and volatility and increase returns. A proper selection of hedge funds can create uncorrelated returns, adding a level of diversification. In doing so, the client would be incurring the following risks. Expenses can be quite high. The risky strategies could backfire, leading to significant loss of capital. Liquidity risk. During the lockup period, the investor is locked in to the investment. Furthermore, even after that period, there is no active secondary market for these unregistered securities. They are not listed on any exchanges. Finally, as is generally the case with limited partnership investments, the sale of partnership interests may require approval of the general partner. Examples: Julia, an IAR, is analyzing various policies utilized by hedge funds recommended by her firm. Julia has summarized the policies as follows. Policy 1. During the fundraising period, each new investor must contribute a minimum of $500,000 to the fund. Policy 2. The hedge fund manager will return incentive fees to investors in the event that the minimum required return is not met. Policy 3. Investors must provide redemption requests to the hedge fund manager at least 60 days before the funds are to be withdrawn. Policy 4. New investors may not withdraw funds during the first 6 months that the funds are invested with the hedge fund manager. 1. Which of the policies identified by Julia specifies a lockup period? Policy 1B of Policy 2C, Policy 3D of Policy 4. Answer. D. The lockup period refers to a set period, such as 6 months, choice D, that an investor's funds must remain invested in the hedge fund. During that time period, withdrawal requests are not permitted. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 333. S65_LEM.INF 333 March 15, 2019, 10:58 and 43 seconds a.m. 2. One of your clients wishes to invest in a hedge fund. You should explain which of the following points. A. Shares of these funds are easy to redeem. B. The fund can be expected to generate a profit whether the markets trend up or trend down. C. These funds purchase a large amount of preferred stock. D. Expenses for these funds tend to be higher than those for traditional mutual funds. Answer. D. One of the distinguishing characteristics of hedge funds is their high fee structure when compared to mutual funds. Choice D. Hedge funds typically use risky strategies to generate profit regardless of market direction, but there is no assurance that the objective will be realized. Redemption may be difficult with these funds. REITs. What are the benefits of including REITs in a client's portfolio? The opportunity to invest in real estate without the degree of liquidity risk found in direct ownership properties are selected by professionals with greater negotiating power than an individual in negative correlation to the general stock market, because real estate prices and the stock market frequently move in opposite directions. Reasonable income and/or potential capital appreciation. In doing so, the client would be incurring the following risks. Lack of control, because much of the risk in investing in REITs lies with the quality of the management. REITs generally have greater price volatility than direct ownership of real estate because they are influenced by stock market conditions. Dividends are not considered qualified for purposes of the 15% maximum tax rate and are taxed at full ordinary income rates. If the REIT is not publicly traded, liquidity is very limited. While a portion of total shares outstanding may be redeemable each year, subject to limitations, redemption offers may be priced below the purchase price or current price. As a result, there is the need for more stringent suitability standards, and the regulators give greater scrutiny to trades in unlisted REITs. Failure to meet the distribution rules could cause the REIT to be taxed. Problem loans in the portfolio could cause income and/or capital to decrease. 334, Unit 14 Types and Characteristics of Pooled Investments. S65_LEM.INF 334 March 15, 2019, 10:58 and 43 seconds a.m. Example. 1. In order for a REIT to avoid being taxed like a corporation, it must distribute at least 75% of its taxable income, B. 90% of its taxable income, C. 95% of its taxable income, D. 100% of its taxable income. Answer. B. In order to qualify under IRS regulations, REITs must distribute at least 90%, choice B, of their taxable income in the form of dividends to shareholders. At least 75% of the REIT's income must come from real estate investments. Unit 14. Unit 14 Types and Characteristics of Pooled Investments 335. S65_LEM.INF 335 March 15, 2019, 10:58 and 43 seconds a.m. S65_LEM.INF 336 March 15, 2019, 10:58 and 44 seconds a.m. In the previous unit, we discussed a number of different pooled investment vehicles. In this unit, we're going to cover two more, variable annuities and variable life insurance. But those are not the only insurance-based products that are relevant to this exam. Even though the others we'll discuss are not securities, understanding what they are and their basic features are testable items. The Series 65 exam will include approximately 2 questions on the material presented in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. You U15L01, contrast the difference between fixed and variable annuities. U15L02, compare the differences between variable annuities and mutual funds. U15L03, compute the account return for an index annuity. U15L04, compare the different purchase and settlement options for annuities. U15L05, calculate the tax on an early withdrawal from an annuity. U15L06, compare the major types of life insurance. U15L07, identify the special features applicable to a variable life policy. Types of annuities. U15L01, contrast the difference between fixed and variable annuities. Although many products offered by insurance companies are not securities, the securities professional should be aware of the features of both securities and non-securities offerings. 15. Unit. Insurance-based products. 337. S65_LEM.INF 337 March 15, 2019, 10:58 and 44 seconds a.m. An annuity is generally a contract between an individual and a life insurance company, usually purchased for retirement income. An investor, the annuitant, pays the premium in one lump sum or in periodic payments. At a future date, the annuitant can either elect to surrender the policy and receive a lump sum payout or begin receiving regular income distributions that will continue for life. Because all earnings are tax-deferred, many individuals looking to accumulate additional funds for retirement find annuities to be a valuable tool. Unlike IRAs and qualified retirement plans, covered in Unit 24, which limit the amount that can be contributed, there is no legal limit to the amount that can be invested in an annuity. The insurance company may place a limit, generally in the range of $1 to $3 million, that it will accept. Annuity contracts are classified into two major types, depending on the payout the annuity makes. Fixed annuities. Variable annuities. Fixed annuities. A fixed annuity guarantees a fixed rate of return. When the individual elects to begin receiving income, the payout is determined by the account's value and the annuitant's life expectancy based on mortality tables. A fixed annuity payout remains constant throughout the annuitant's life. Take note. Because the insurance company guarantees the return and the annuitant bears no risk, a fixed annuity is an insurance product and not a security. A salesperson must have a life insurance license to sell fixed annuities, but does not need to be securities licensed. Although principal and interest are not at risk, a fixed annuity risks loss of purchasing power because of inflation. Example. An individual who annuitized a contract in 1990 may have been guaranteed a monthly payout of $800. Decades later, this amount may prove insufficient to live on. Variable annuities. Instead of purchase payments being directed to the insurance company's general account, money deposited in a variable annuity is directed into one or more sub-accounts of the company's separate account. Although the options include money market securities and bonds, purchase payments are frequently invested in a stock portfolio, which has a better chance of keeping pace with inflation than fixed income investments. The greater potential gain of a variable annuity involves more potential risk than a fixed annuity because it invests in securities rather than accepting the insurance company's guarantees. Payouts may vary considerably because an annuity unit's worth fluctuates with the value of the selected sub-accounts. 338, Unit 15 Insurance-based products. S65_LEM.INF 338 March 15, 2019, 10:58 and 44 seconds a.m. Fixed annuities. Variable annuities monthly payout is fixed monthly payout varies guaranteed interest rate variable rate of return investment risk assumed by insurance company investment risk assumed by annuitant portfolio of fixed income securities and mortgages portfolio of equities, debt, money market instruments, general account, separate account, vulnerable to inflation, resistant to inflation, insurance regulation, insurance, and securities regulation. Example. 1. The key difference between a fixed annuity and a variable annuity is that the fixed annuity A offers a guaranteed return, B offers a monthly payment that may vary in amount, C will always pay out more money than a variable annuity, D attempts to offer protection to the annuitant from inflation risk. Answer. If an annuity is fixed, it means the return to the investor is guaranteed, choice A, whereas with a variable annuity, there are no guarantees as to the amount of return. It is the variable annuity whose annuity payment will vary and, because of the growth opportunity, offers potential inflation protection. Separate account. The contributions that investors make to a variable annuity are kept in a separate account from the insurance company's general funds. Investors determine which of the sub-accounts into which their money will be placed. Some insurance companies' separate accounts offer 25, 30, or even more sub-accounts from the most aggressive to the most conservative. Because the investor rather than the insurance company bears the risk, a variable annuity is considered to be a security. As a consequence, variable annuity salespersons must have both a securities license, registered with a broker-dealer member of FINRA and the applicable state or states, and an insurance license issued by the appropriate states. Test topic alert. It is the performance of the specific sub-accounts selected by the investor that determines the investment return. Unit 15. Unit 15 Insurance-Based Products, 339. S65_LEM.INF 339 March 15, 2019, 10:58 and 44 seconds AM. Is a variable annuity a mutual fund? U15LO2, compare the differences between variable annuities and mutual funds. In the eyes of many novice investors, there doesn't seem to be very much difference between a mutual fund and a variable annuity. Although there are many similarities, there are critical differences. The following chart is a good place to begin. Figure 15.1, Principal Features of Mutual Funds versus Variable Annuities. Mutual funds, variable annuities, investment company, insurance company, product, shares, units, investment objectives, varied investment objectives, varied, no guarantees, some guarantees, redeemed by issuer price, based on formula voting rights. Looking at the above chart, there doesn't seem to be much difference other than one being an insurance product with some guarantees and the other not. Let's look a bit deeper. Advantages to investing in variable annuities compared to mutual funds. Tax-deferred growth. All income and capital gains generated in the portfolio of the separate account are free from income tax until the money is withdrawn. Over time, this tax-deferred compounding can make a significant difference in the value of the account. Guaranteed death benefit. Most variable annuities offer an option stating that if the investor dies during the accumulation period, the beneficiary will receive the greater of the current value of the account or the amount invested. Therefore, the estate is assured of getting back at least the original investment. Lifetime income. Although a variable annuity cannot guarantee how much will be paid, choosing a payout option with lifetime benefits gives assurance that there will be a check every month as long as the annuitant is alive. This benefit protects against longevity risk, the uncertainty that one will outlive one's money. Be sure that you don't refer to this as guaranteed income. That would be an incorrect statement on the exam because the income is variable. IRS Section 1035 Exchanges. If you don't like the annuity you're in, you can exchange into another one without any tax consequences. However, it is possible there will be a surrender charge. This is unlike mutual funds, for which use of the exchange privilege is a taxable event. No age 70.5 restrictions or requirements. Unlike traditional retirement plans that have required minimum distributions after the age of 70.5, an investor can delay withdrawals as desired and, in fact, can continue to contribute. No contribution limits. Unlike retirement plans, where the annual contribution is limited, no IRS ceiling is placed on the amount that may be invested into a fixed or variable annuity. 340 Unit 15 Insurance-Based Products. S65_LEM.INF 340 March 15, 2019, 10:58 and 44 seconds AM. Tax-free transfer between sub-accounts. Unlike mutual funds where the exchange between funds is a taxable event, the investor can transfer from one subaccount to another without any current tax liability. No probate, because the annuity calls for direct designation of a beneficiary. Upon death, the asset passes directly without the time and expense of probate. Disadvantages to investing in variable annuities compared to mutual funds. Earnings are taxed as ordinary income, even though it is possible that most of the increase in value is generated through long-term capital gains. All earnings will be taxed at the higher ordinary income rate. The administrative and insurance-related expense fees are typically much higher than the fees incurred by owning a mutual fund. Withdrawals made before age 59.5 will generally incur a 10% penalty, in addition to the ordinary income tax. Most variable annuities carry a conditional deferred sales charge. Therefore, surrender in the early years will usually involve additional costs. Test topic alert. A variable annuity offers an investor the opportunity to have tax-deferred participation in the equity markets, albeit with expenses that are generally higher than for a mutual fund with a similar objective. The test topic alert shown above represents an idea that is commonly tested. It could look something like this. Example 1. When comparing mutual funds and variable annuities, it would be correct to state that A. Both offer tax-deferred growth of earnings. B. Both require the salesperson to possess a securities and an insurance license. C. The surrender charges on a mutual fund are usually higher than on a variable annuity. D. The expense ratio of the variable annuity is usually higher than that of a comparable mutual fund. Answer. D. It is generally correct to state that variable annuities offer a way to accumulate funds on a tax-deferred basis, although generally with operating expenses somewhat higher than mutual funds with the same investment objective. There is no tax deferral with mutual funds, and no insurance license is required to sell them. Only Class B and C shares have redemption fees, a form of surrender charge, and they are invariable lower and/or run for fewer years than annuity surrender charges. Unit 15. Unit 15 Insurance-Based Products, 341. S65_LEM.INV 341 March 15, 2019, 10:58 and 45 seconds a.m. Index Annuity. U15LO3, compute the account return for an index annuity. In an effort to overcome the purchasing power risk of fixed annuities, but without the market risk of the variable annuity, the industry developed the index annuity, IA. This product is sometimes called an equity index annuity or a fixed index annuity. Indexed annuities, IAs, are currently popular among investors seeking market participation but with a guarantee against loss. Unlike a traditional fixed annuity, an IA credits interest to the owner's account using a formula based on the performance of a particular stock index, such as the S&P 500. If the index does well, the annuitant is credited with a specified percentage of the growth of the index, typically 80% or 90% of the growth. This is known as the participation rate. If, over the life of the annuity, the index does poorly, the annuitant may receive the IA's minimum guaranteed return, typically 1 to 3%. In addition to the participation rate, there is usually a cap rate. A typical cap might be 8%. This means that if your annuity was pegged to the S&P 500, the net index increased 20% during the year, your gain would be capped at 8%. One other negative characteristic of these products is that they tend to have longer surrender charge periods, as long as 15 years, than other annuities, especially if there is a front-end bonus. Example. To give you an idea of how an IA might work, consider one with a participation rate of 80%, a cap rate of 8%, and a minimum guarantee of 2%. If the index shows growth of 9% during the IA's measurement period, the annuitant would be credited with 7.2% growth, 80% of 9%, which is less than the cap of 8%. However, if the index grew at a rate of 12%, the participation rate of 80% would yield 9.6%, but, because that is over the 8% cap, the account would only be credited with 8%. In any year where the index declines, the annuitant's account is not credited with any earnings, but, and this is the real benefit, the account does not lose any value either. The 2% guaranteed rate would apply if, over the term of the annuity, performance was less than 2%. Take note. Although index annuity is the preferred term in the industry, your exam may refer to this product as an equity index annuity. Test topic alert. In NIEVES' never-ending battle to try to baffle potential investment advisor representatives with questions about products they will most likely never handle, we are hearing from students that you should know the different crediting methods used for index annuities. Without going into the technicalities, it seems all you have to know is the different types, not a lot about how they work. The purchaser can be offered the following choices as to how growth in the underlying index will be credited in the form of interest to the account. Annual reset. In this method, the interest to be credited to the account is computed by comparing the index value at the end of the year to the value. 342 Unit 15 Insurance-based products. S65_LEM.end 342 March 15, 2019, 10:58 and 45 seconds a.m. At the beginning of the year, hence the term annual reset generally has a lower participation rate than point-to-point. High water mark. In this method, the highest value reached by the index between anniversary dates of the annuity is compared to the value at the beginning of the year. This option can provide the highest gains. Point-to-point. In this method, the interest is computed based on the value of the index at the end of the contract compared to the beginning. A variation is annual point-to-point. Averaging. The most common is a monthly average, and this can be the best options when markets are expected to be highly volatile. Purchasing annuities. U15LO4. Compare the different purchase and settlement options for annuities. Insurance companies offer a number of purchase options to make it easy for annuity owners to accumulate money. Deferred annuity. An annuity may be purchased with a single lump sum investment, with payout of benefits deferred until the annuitant elects to receive them. This type of investment is referred to as a single premium deferred annuity. Periodic payment deferred annuity. A periodic payment deferred annuity allows a person to make periodic payments. The contract holder can invest money on a monthly, quarterly, or annual basis, with payout of benefits deferred until the annuitant elects to receive them. Immediate annuity. An investor may purchase an immediate annuity contract by depositing a single lump sum. The insurance company begins to pay out the annuity's benefits immediately, usually within 60 days. Accumulation stage. The pay-in period for a deferred annuity is known as the accumulation stage. There is no accumulation period for an immediate annuity. During the accumulation stage of an annuity contract, the contract terms are flexible. An investor who misses a periodic payment is in no danger of forfeiting the preceding contributions. The contract holder can terminate the contract at any time during the accumulation stage, although the contract holder is likely to incur surrender charges on amounts withdrawn in the first 5 to 10 years after issuance of the contract. Unit 15. Unit 15 Insurance-based products, 343. S65_LEM.end 343 March 15, 2019, 10:58 and 45 seconds a.m. Accumulation units. An accumulation unit is an accounting measure that represents an investor's share of ownership in the separate account. An accumulation unit's value is determined in the same way as the value of mutual fund shares. The unit value changes with the value of the securities held in the separate account. The names of various purchase options are quite descriptive of how they operate and should not be difficult to follow. Just to be sure, let's try the following question. Example. 1. Insurance companies selling annuities offer a variety of purchase options to owners. Which of the following definitions regarding these annuity options is not true? Accumulation annuity, an annuity that allows the investor to accumulate funds in a separate account before investment in an annuity. B. The single premium deferred annuity, an annuity with a lump sum investment, with payment of benefits deferred until the annuitant elects to receive them. C. Periodic payment deferred annuity, allows a person to make periodic payments over time. The contract holder can invest money on a monthly, quarterly, or annual basis. D. Immediate annuity, allows an investor to deposit a lump sum with the insurance company. Payout of the annuitant's benefits starts immediately, usually within 60 days. Answer: accumulation does not refer to a purchase option. The pay-in period for an annuity is known as the accumulation stage. A single premium deferred annuity is an annuity with a lump sum investment, with payment of benefits deferred until the annuitant elects to receive them. Periodic payment deferred annuities allow a person to make periodic payments over time. Immediate annuities allow an investor to deposit a lump sum with the insurance company. Payout of the annuitant's benefits starting immediately, usually within 60 days. Bonus annuities. It is not uncommon for index annuities and variable annuities to offer a bonus on top of the investor's initial contribution. For example, investing $60,000 into a single premium annuity with a 5% bonus would result in an initial account balance of $63,000. Usually, bonus annuities have surrender charges lasting longer than those without the bonus. Receiving distributions from annuities. The payout period for an annuity is known as the annuity stage. It happens when the owner of the annuity annuitizes. 344 Unit 15 Insurance-based products. S65_LEM.end 344 March 15, 2019, 10:58 and 45 seconds a.m. Annuity payout options. It is now time for the contract holder to decide on the settlement option. An annuity offers several payout options for amounts accumulated in the annuity contract. The investor can let the money accumulate in the annuity, withdraw the accumulated funds in a lump sum, or withdraw the accumulated funds periodically by annuitizing the contract. Annuitizing occurs when the investor converts from the accumulation, pay-in, stage to the distribution, payout stage. The decision to annuitize the contract locks in the specified payout option. The contract holder may not change it. Annuity payout options, in order from largest monthly payout to smallest monthly payout, follow. Life annuity / straight life / pure life. Under this option, the payout is structured so that the annuitant receives periodic payments, usually monthly, until death. No added options or benefits exist, therefore, for a given amount of funds, this option provides the largest periodic payment. This is because it carries the greatest risk. The annuitant could get hit by a truck 1 month after annuitizing and all payments cease. Life annuity with period certain. Under the life annuity with period certain payout option, an annuitant receives payments for life, with a certain minimum period guaranteed. If the annuitant dies before the period certain expires, payments continue to the annuitant's named beneficiaries for the period certain. If the annuitant lives beyond the period certain, payments continue until the annuitant's death. Example: a client purchases a life annuity with a 10-year period certain payout. The insurance company guarantees payments for the life of the annuitant or 10 years, whichever is longer. If the annuitant lives for only 1 year after payments begin, the company continues to make payments to the annuitant's beneficiaries for 9 more years. If the annuitant dies after receiving payments for 13 years, payments cease at death. Joint life with last survivor annuity. With this option, the annuity covers 2 or more people, and payout is conditioned on both, all, lives. Example: a married couple owns an annuity jointly with a last survivor clause. The contract pays benefits as long as one of the annuitants remains alive. The payment may be the same as when both were alive, or it may be reduced for the surviving annuitant, depending on the contract. If this option includes more than 2 annuitants, payments cease at the last survivor's death. Unit 15. Unit 15 Insurance-based products, 345. S65_LEM.INF345 March 15, 2019, 10:58 and 45 seconds a.m. Refund annuity. Sometimes referred to as a unit refund annuity, under this settlement option, payments will continue after death of the insured until the full value of the initial premium, principal, has been returned. In some cases, the payment to the beneficiary will be a lump sum of cash, in others, a series of monthly payments. Mortality guarantee. Annuity companies guarantee payments for as long as annuitants live. If a change occurs in life expectancy and annuitants live longer than originally anticipated, the insurance companies assume the increased mortality cost, the mortality guarantee. Among the annual charges against the account is that for MNE, mortality and expense. Test topic alert. The MNE charge ceases once the contract is annuitized. Examples. 1. Which of the following types of annuity settlement options provides a lifetime income to the annuitant regardless of how long he lives and the highest monthly payment amount? A. Straight life annuity. B. Life annuity with period certain. C. Installment refund annuity. D. Joint and survivor annuity. Answer. A straight life annuity, choice A, provides a lifetime income to the owner/annuitant regardless of how long he lives. If the annuitant is fortunate to outlive his anticipated life expectancy, he has made a wise distribution choice. However, if he dies shortly after beginning distribution, he has made an imprudent choice because, after the annuitant dies, the issuer makes no further payments. Nevertheless, for a given purchase price, a single life annuity provides the highest monthly payment amount because the annuity provides no guarantees beyond the annuitant's life. 2. Peter and Connie are thinking about selecting a settlement option for their variable annuity. If their objective is to have the annuity provide income until both of them are deceased, which of the following settlement options will best meet their needs? A. Straight life annuity. B. Joint and survivor annuity. C. Installment refund annuity. D. Life annuity with period certain. Answer. B. The joint and survivor annuity, choice B, will allow the couple to have the annuity provide income until both of them are deceased. The payment will be lower than on a straight life annuity because two lives are involved rather than one, more risk for the insurance company, less risk for the annuitants. For a given purchase price, a straight life annuity generally provides the highest monthly payment amount because the annuity. 346 Unit 15 Insurance-based products. S65_LEM.INF346 March 15, 2019, 10:58 and 45 seconds a.m. Provides no payments beyond the annuitant's life. It is the old rule of the risk-reward relationship. The more risk you take, the higher the reward. Annuity units. When a variable annuity contract is annuitized, accumulation units are exchanged for annuity units. An annuity unit is a measure of value used only during an annuitized contract's payout period. It is an accounting measure that determines the amount of each payment to the annuitant during the payout period. The number of annuity units is calculated when an owner annuitizes the contract. The number of annuity units liquidated each month does not change. It is fixed at the time of annuitizing based on the value of the contract when the payout period begins and on other variables, such as the payout option selected, the individual's age and sex, and assumed interest rate. The payment the annuitant will receive each month varies because each unit's value fluctuates with the separate account portfolio's value. This is, after all, a variable annuity. Assumed interest rate, AIR. The AIR is a basis for determining distributions from a variable annuity. The rate, usually estimated conservatively, provides an earnings target for the separate account. Simply, if the actual earnings exceed the AIR, the annuity payments increase. If they fall short of the AIR, the payments decrease. Example. An investor who annuitized a variable annuity in 1990 and began with a monthly payout of $375 might now be receiving $2,275 per month because of an increase in the value of the annuity unit. Taxation of annuities. U15LO5, calculate the tax on an early withdrawal from an annuity. Contributions to an annuity that is not part of an employer-sponsored retirement plan, qualified annuities, are made with after-tax dollars, non-qualified. Because contributions have been taxed already, when the account is annuitized, the portion of each payment representing a return of the original principal is not taxed. As with other investments, the money invested in an annuity represents the investor's cost basis. The primary advantage of an annuity as an investment is that the tax on interest, dividends, and capital gains is deferred until the owner withdraws money from the contract. On withdrawal, the amount exceeding the investor's cost basis is taxed as ordinary income. Random withdrawals. Since 1982, random withdrawals from annuity contracts have been taxed under the last-in, first-out, LIFO method. The IRS takes the view that earnings are the last monies to be received in the account. The earnings are considered to be withdrawn first from the annuity. Unit 15. Unit 15 Insurance-Based Products, 347. S65_LEM.INV 347 March 15, 2019, 10:58 and 45 seconds a.m. and are taxable as ordinary income. After the withdrawal of all earnings, contributions representing cost basis may be withdrawn without tax. Lump sum withdrawals. Lump sum withdrawals are taken by using the LIFO accounting method. This means that earnings are removed before contributions. If an investor receives a lump sum withdrawal before age 59 and a half, the earnings portion withdrawn is taxed as ordinary income and is subject to an additional 10% tax penalty under most circumstances. The penalty does not apply if the funds are withdrawn after age 59 and a half, are withdrawn because of death or disability, or are part of a life income option plan with fixed payouts. Example: a contract with a $100,000 value consists of $40,000 in contributions and $60,000 in earnings. If the investor withdraws all $100,000 at once, the $60,000 in earnings is taxed as ordinary income and the $40,000 cost basis is returned tax-free. If the investor is at least 59 and a half, there is no 10% tax penalty. If younger, the 10% tax penalty applies. However, the penalty only applies to the taxable portion, $60,000. There is never a penalty tax on money that is not taxable. If the investor withdraws $10,000, or any amount up to $60,000, under the LIFO rule, it is considered a withdrawal of earnings and will be taxed as ordinary income. There is never a capital gain with an annuity. Test topic alert. Yes, it is true. Even when the distribution is from a non-qualified annuity, if it is made before the age of 59 and a half, it is subject to the 10% additional tax, unless it meets one of the exceptions listed above. Annuitized payouts are typically made monthly and are taxed according to an exclusion ratio. The exclusion ratio expresses the percentages of the annuity's value upon annuitization of contribution basis to the total. Example: if $50,000 in after-tax dollars was contributed to an annuity contract worth $100,000 at annuitization, 50% of each payment will be treated as ordinary income, whereas the other 50% of each payment will be treated, for tax purposes, as non-taxable return of basis. Under certain circumstances, the annuitant's life expectancy may also factor in the exclusion ratio, but that is unlikely to be tested. We're just keeping it simple. Test topic alert. Upon annuitization, there is never a 10% tax penalty, even if annuitization commences before age 59 and a half. Some additional tax concepts related to annuities are demonstrated here. 348 Unit 15 Insurance-Based Products. S65_LEM.INV 348 March 15, 2019, 10:58 and 45 seconds a.m. Examples: 1. An annuity contract owner, age 45, surrenders the annuity to buy a home. Which of the following best describes the tax consequences of this action? Ordinary income taxes and a 10% early withdrawal penalty will apply to all money withdrawn. B. capital gains tax will apply to the amount of the withdrawal that represents earnings. There will be no tax on the cost basis. C. Ordinary income taxes and a 10% early withdrawal penalty will apply to the amount of the withdrawal that represents earnings. There will be no tax on the cost basis. D. Ordinary income taxes apply to the amount of the withdrawal that represents earnings. The 10% early withdrawal penalty does not apply to surrendering an annuity. Answer. C. Interest earnings are taxable as ordinary income. They are also subject to the 10% early withdrawal penalty when withdrawn before age 59 and a half. The contract holder recovers the cost basis without tax. 2. After the death of the annuitant, beneficiaries under a life and 15-year period certain option are subject to a. Capital gains taxation on the total amount of payments received. B. Ordinary income taxation on the total amount of payments received, plus a 10% withdrawal penalty if the annuitant was under age 59 and a half. C. Ordinary income taxation on the amount of the payout that exceeds the cost basis, based on the exclusion ratio. D. Tax-free payout of all remaining annuity benefits. Answer. C. Payments from the annuity to the beneficiary through a period certain option are taxed in the same way as other periodic annuity payments. Benefits over the amount of the cost basis are taxable as ordinary income. However, no 10% penalty applies in this situation. Life insurance. U15L06. Compare the major types of life insurance. A life insurance policy is a contract between an insurance company and an individual that is designed to provide financial compensation to the named beneficiaries in the event of the insured's death. In exchange for payment of premiums, the insurance company agrees to pay the proceeds of the policy, the death benefit, upon the death of the insured. Many types of life insurance contracts are available, each type serves a different need. We will focus more attention on those contracts that use separate accounts to fund the death benefits and those that are considered securities, as defined by the Uniform Securities Act. Unit 15. Unit 15 Insurance-Based Products, 349. S65_LEM.IND 349 March 15, 2019, 10:58 and 46 seconds a.m. Term insurance. Term insurance is protection for a specified period, hence the description, term. Term insurance provides pure protection and is the least expensive form of life insurance. The important facts about term life insurance policies include the following. They provide temporary insurance protection for a specified period, the policy term. For example, the term may be 1 year, 5 years, 10 years, 30 years, or to a specified age, such as age 65. They pay the death benefit only if the insured dies during the term of coverage. For example, a person buying a 20-year term policy at age 35 who dies at 56 will receive nothing. They do not accumulate cash value. The death protection and premium remain level for the specified term, e.g. a $100,000 5-year term policy provides a death benefit of $100,000 any time during that 5-year term. If renewed at the end of the term, the face amount remains the same, but, because the new premium is based upon the insured's attained age, renewal premiums always increase. Uses of term insurance. Term insurance has a variety of useful applications. One of the most common uses for term is to provide a substantial amount of coverage at a minimum cost. Because term insurance provides pure protection, it allows a person with a limited income to purchase more coverage than might otherwise be affordable. This is particularly important when there is a clear need for additional protection, particularly in the case of younger people, married with children. Test topic alert. For test purposes, younger people with children are better off purchasing term insurance because the lower premiums allow significantly more protection. For those aged 60 and older, the rates are generally prohibitive. Whole life insurance, WLI. A type of permanent or cash value insurance, whole life insurance, WLI, provides protection for the whole of life. Coverage begins on the date of issue and continues to the date of the insured's death, provided the premiums are paid. The benefit payable is the face amount, or face value, of a policy, which remains constant throughout the policy's life. The premium is set at the time of the policy's issue and it, too, remains level for the policy's life. As with all life insurance policies, the insured can choose how to spread out the premium payments, known as the mode. Premiums can be paid annually, semi-annually, quarterly, or monthly. Cash values. Unlike term insurance, which provides only a death benefit, WLI combines a death benefit with an accumulation, or a savings element. This accumulation, commonly referred to as the policy's cash surrender value, increases each year the policy is kept in force. In traditional WLI, the insurer invests reserves in conservative investments, example, bonds, real estate, mortgage loans. 350 Unit 15 Insurance-based products. S65_LEM.IND 350 March 15, 2019, 10:58 and 46 seconds AM. Because of the low risk of such investments, the insurer can guarantee the policy's cash value and the non-forfeiture options that are based on that cash value. Traditional life insurance reserves are held in the insurer's general accounts. Policy loans. Once an insured has accumulated cash value, it cannot be forfeited. An insured may cash in a policy at any time by surrendering it in exchange for its cash value. An insured may also borrow a portion of the cash value in the form of a policy loan, but this must be paid back, with interest, to restore policy values. When a policy owner takes a cash value loan, the amount borrowed, and any accumulated interest due on the loan become an indebtedness against the policy. If the insured dies before the loan has been repaid, any indebtedness will reduce the face amount of the policy accordingly. It will be subtracted from any death benefit. Uses of whole life. The principal advantage of whole life is that it is permanent insurance and accordingly can be used to satisfy permanent needs such as the cost of death, dying, and final burial expenses. The level premium allows the policy owner to always know exactly what the cost of insurance will be, and basically offers a form of forced savings. Whole life builds a living benefit through its guaranteed cash value that enables the policy owner to use some of this cash, through policy loans, for emergencies, as a supplemental source of retirement income, and for other living needs. The principal disadvantages of WLI are that the premium paying period may last longer than the insured's income-producing years, and it does not provide as much protection per dollar of premium as term insurance. Whole life versus term. Guaranteed interest rate on cash value buildup, term insurance, will provide the highest face amount for the lowest premium. Builds cash value with ability to borrow. Term insurance does not build cash value. Remains in effect until age 100 as long as premiums are paid. Term insurance provides coverage for a specific period. It is pure protection. Example. 1. A 30-year-old client indicates that he needs $500,000 of life insurance coverage for the next 20 years. The lowest out-of-pocket cost would be if he purchased A 20-pay life policy, B 20-year level term policy, C whole life policy, D variable annuity with an extended death benefit. Answer: B. In almost all circumstances, certainly for short to immediate time periods, term life will be the least expensive form of insurance. A 20-pay life is a permanent policy where the premiums are paid in a 20-year period rather than until death. Variable annuities are not life insurance policies even though they are issued by life insurance companies. Unit 15. Unit 15 Insurance-based products, 351. S65_LEM.IND 351 March 15, 2019, 10:58 and 46 seconds AM. Surrendering the policy. If the policy owner decides to stop paying the premiums, the policy owner may surrender the policy for its cash value. Take a reduced paid-up policy where the death benefit is decreased and future premiums are no longer required, or take extended term insurance, which pays the beneficiaries the full face amount if death occurs within a specified time period. Universal life. Universal life insurance was developed in the late 1970s in response to the relatively low interest rates, generally 3.5 to 5%, earned by traditional whole life insurance cash values, which made the whole life product less attractive during periods of high inflation. To be more competitive, insurers introduced universal life policies that might pay higher interest rates, such as 8%, 10%, or even 12% during inflationary times. These policies also provide greater flexibility because they allow policy owners to adjust the death benefits and/or premium payments based on current needs assessment. A universal life policy is similar to a whole life policy in the sense that it has the same two components, death protection and cash value. However, instead of being fixed and guaranteed amounts, the death protection resembles one-year renewable term insurance and the cash value grows according to current interest rates. Characteristics of universal life. Premium payments are separated, first being paid toward the insurance protection, with the remaining balance being used to build the cash value, with interest. The policy owner may increase or decrease the death benefit during the policy term, subject to any insurability requirements. Premium amounts may be changed as long as enough premium is paid to maintain the policy. This is why universal life is known as flexible premium life. In fact, it is even possible to skip premium payments as long as there is sufficient cash value in the policy to keep it in force. The interest earned by the cash account will vary, subject to a guaranteed minimum. Universal life interest rates. Universal life contracts are subject to two different interest rates, the current annual rate and the contract rate. The current annual rate varies with current market conditions and may change every year. The contract rate is the minimum guaranteed interest rate, and the policy will never pay less than that amount. For example, if the guaranteed contract rate is 5% and the current rate is 8%, the cash account would grow by the higher 8% during that year. But if the current rate falls below 5%, the cash account would still grow by the minimum rate of 5% during that year. 352 Unit 15 Insurance-Based Products. S65_LEM.INT 352 March 15, 2019, 10:58 and 46 seconds a.m. Universal Life Death Benefits. Generally, two options are available regarding the death benefit payable under a universal life policy. Option 1, also known as Option A, provides a level death benefit equal to the policy's face amount. As the policy's cash value increases, net death protection actually decreases over the life of the policy, which makes the policy structure similar to a whole life contract. The major advantage of Option 1 is that the premiums are lower for the same face amount of death coverage. The trade-off is that the level death benefit will not keep pace with inflation. Option 2, also known as Option B, provides for an increasing death benefit equal to the policy's face amount plus the cash account. In terms of policy structure, this contract is more like a combination of level term insurance and increasing cash value than WLI. The primary advantage of universal life insurance Option B is that cash values grow more quickly over time. The cash values accumulate more quickly because of the higher initial premiums and lower initial death benefit. Because the premiums are higher and the death benefit is initially lower, a greater portion of the premium is added to the policy cash value, which then grows interest-free inside the contract. Take note. With the original universal life policies, it was common that the flexibility of premium payments caused policies to lapse, with the result that one could not truly say there was a guaranteed death benefit. Because of this, most insurers today offer a guaranteed death benefit universal life where the policy is guaranteed not to lapse if the sum of the premiums paid, less any loans or partial withdrawals and partial withdrawal fees, is greater than or equal to the sum of the minimum monthly premiums required. As a result, one can say that a universal life insurance policy has at least some guaranteed death benefit. Universal life policy loans. Universal life provides for cash value loans in the same manner that whole life or any permanent plan of insurance does. If a loan is taken, it is subject to interest and, if unpaid, both the interest and the loan amount will reduce the face amount of the policy. Uses of universal life. This is a form of permanent insurance that can build cash values, hopefully at a rate greater than with traditional whole life. There is typically a guaranteed minimum interest rate stated in the policy, usually around 2%, which means that, no matter how the investments perform, there will be a known minimum return on the investment. The unique feature is the flexibility to adjust the death benefit as needs change, as well as the flexibility to pay smaller or larger premiums as financial conditions dictate. However, if the premium payments are reduced to the point where they can no longer support the policy, lapse could occur. Another use of the flexibility of the premium payments is to overfund the policy, particularly when option 2 has been chosen. That is, pay premiums in excess of those required, with that excess going into the savings portion of the policy. This can have the effect of greatly increasing the cash value. Money that may be borrowed out of the policy without tax consequences if done properly. This is beyond the coverage of this course. Unit 15. Unit 15 Insurance-Based Products, 353. S65_LEM.INF 353 March 15, 2019, 10:58 and 46 seconds AM. Example. 1. All of the following are advantages of universal life insurance except an ability to adjust the amount of premium payments. B. The policy is guaranteed never to lapse. C. Ability to change death benefit amount. D. When the cash value is sufficient, no premium payment is required. Answer. B. The universal life policy may lapse if the accumulation fund drops below a specified level and an additional premium is not paid. Universal life has flexible premiums and, when there is sufficient cash value in the policy, premiums may be skipped, with the premium payments taken from that cash value. Variable life insurance. Variable life insurance differs from WLI in that the premiums are invested not in the insurance company's general account, whose investments are determined by the insurance company, but in a separate account, in whose investments the insured has some choice, common stock, bonds, money market instruments, and so on. The purpose is to let the customer assume some investment risk in an attempt to get inflation protection for the policy's death benefit. Cash value in the policy fluctuates with the performance of the chosen sub-accounts in the separate account and is not guaranteed. Variable life policies provide policy owners with a minimum guaranteed death benefit. The benefit may increase above this minimum amount depending on investment results, but may never fall below. Also, remember what was said earlier about variable annuities being securities requiring those who sell them to be duly licensed, insurance and securities. The same is true for those who wish to sell variable life insurance. Scheduled, fixed, premium variable life. A scheduled premium or fixed premium VLI contract is issued with a minimum guaranteed death benefit. The premiums for some variable life contracts are flexible. This is discussed next under variable universal life. A scheduled premium VLI contract's death benefit is determined at issue, and evidence of insurability is required. The premium is calculated according to the insured's age and sex and the policy's face amount, guaranteed amount, at issue. Once the premium has been determined and the expenses have been deducted, the net premium is invested in the separate account sub-accounts the policy owner selects. Flexible premium variable life, universal. Universal variable life insurance, UVL or VUL, is a type of variable life insurance with flexible premiums, and thus flexible death benefit. Premiums are invested only in a separate account, and there is only a variable death benefit. The insured has the option to increase, skip, or reduce premium payments, though he must maintain a minimum cash value, and the death benefit is adjusted appropriately. 354 Unit 15 Insurance-Based Products. S65_LEM.INF 354 March 15, 2019, 10:58 and 46 seconds AM. Deductions from the premium. Deductions from the gross premium normally reduce the amount of money invested in the separate account. The greater the deductions, the less money available for the investment base in the separate account. Charges deducted from the gross premium include the administrative fee, the sales load, and state premium taxes, if any. The administrative fee is normally a one-time charge to cover the cost of processing the application. The maximum allowable sales load on variable life insurance is the equivalent of an average of 9% of premium per year, computed over a 20-year period. The sales charge may be front-end loaded to 50% of the first year's premium, but must average out to 9% over a 20-year period. Because of the front-end loading, there are special sales charge refund rights for the first 2 years spelled out in the Investment Company Act of 1940. Deductions from the separate account. Deductions from the separate account normally reduce the investment return payable to the policy owner. Charges deducted from the separate account include mortality risk fee, cost of insurance, expense risk fee, and investment management fee. The mortality risk fee covers the risk that the insured may live for a period shorter than assumed. The expense risk fee covers the risk that the cost of administering and issuing the policy may be greater than assumed. And, of course, the investment management fee is the cost of the management of the chosen separate account subaccounts. Take note: the exam may ask you which charges are deducted from the gross premium and which are deducted from the separate account, the net premium. Remember the acronym SAS to make it simple. The charges deducted from the gross premium are sales load, administrative fee, and state premium taxes. Any other charges, such as cost of insurance, expense risk fees, and investment management fees, are deducted from the net premium, which is invested in the separate account. Variable life insurance death benefit. The death benefit payable under a variable life insurance policy consists of 2 parts: a guaranteed minimum provided by the portion of funds invested in the general account and a variable death benefit provided by those invested in the separate account. The guaranteed. Unit 15. Unit 15 Insurance-Based Products, 355. S65_LEM.INT 355, March 15, 2019, 10:58 and 46 seconds a.m. Minimum does not change, but total benefit, including the variable portion of the death benefit, must be recalculated at least annually. The effect that a change in earnings has on the contract's variable death benefit depends on a comparison of actual account performance and the performance assumed by the insurance company. If the separate account returns are greater than the assumed interest rate, additional funds are available to the insured. These extra earnings are reflected in an increase in the death benefit. If the separate account returns equal the actual earnings meet estimated expenses, resulting in no change in benefit levels. Should the separate account returns be less than the contract's death benefit may decrease. However, it may never fall below the amount guaranteed at issue. Take note. If a variable life insurance policy has a minimum stated death benefit, the premiums necessary to fund this part of the death benefit are held in the insurer's general account. Any policy benefit that is guaranteed is invested in the insurer's general account. Any premium above what is necessary to pay for the minimum death benefit is invested in the separate account. This portion of the premium is subject to investment risk. The death benefit will grow above the minimum guaranteed amount if the separate account performs positively. The death benefit will never be less than the minimum guarantee, even if the separate account performs poorly. Take note. With positive performance in the separate account, the death benefit will increase. If this is followed by several periods of performance that fails to equal the death benefit will decline, but never below the minimum guarantee. If the decline has been steep enough, it may take several periods of the positive results before the death benefit increases again. Variable life insurance cash value. The policy's cash values reflect the investments held in the separate account. Unlike the death benefit, the individual policy's cash value must be calculated at least monthly. The cash value, like the death benefit, may increase or decrease depending on the separate account's performance. However, because the cash value is not based on any positive performance will result in cash value growth. If performance has been negative, the cash value may decrease to 0, even if the contract has been in force for several years. The cash value cannot be negative, but the insurance company keeps track of negative performance. Therefore, like the death benefit, the cash value may not increase until prior negative performance has been offset. 356 Unit 15 Insurance-Based Products. S65_LEM.IN356, March 15, 2019, 10:58 and 46 seconds a.m. Test topic alert. The error has no effect on cash value accumulation in a variable life policy. The cash value will grow whenever the separate account has positive performance. The error, however, does affect the death benefit. If the separate account performance for the year is greater than the error, the death benefit will increase. If the separate account performance for the year is equal to the error, the death benefit will stay the same. If the separate account performance for the year is less than the error, the death benefit will decrease, but never below the guaranteed minimum. Test topic alert. You may see a question that asks about the frequency of certain calculations associated with variable life insurance policies. Know that death benefits are calculated annually, cash value is calculated monthly, and separate account unit values are calculated daily in the event there is a withdrawal of cash value. Figure 15.2, Comparison of whole life and variable life policies. Whole life variable life, VLI, universal variable life, UVL or VUL, scheduled premium, flexible premium, fixed death benefit minimum, guaranteed plus variable death benefit, variable death benefit. Premiums to general account, premiums to general and separate account, premiums to separate account. Guaranteed cash value, no guaranteed cash value, no guaranteed cash value. It must be emphasized that variable life insurance must be sold as life insurance, not as an investment. However, the ability to commit a portion of the premium to investor-selected separate account subaccounts makes this form of insurance unique. There is a guaranteed minimum death benefit, but if separate account performance merits such, the death benefit can increase to keep pace with inflation. Cash values, although not guaranteed, can also increase based upon that performance. As with any variable product, the investor bears the investment risk rather than the insurance company. Example 1. Which of the following is indicative of the primary difference between variable life insurance and straight whole life insurance? Amount of insurance that can be issued. B. Cost of the insurance. C. Tax treatment of the death proceeds. D. Way in which the cash values are invested. Unit 15. Unit 15 Insurance-Based Products, 357. S65_LEM.IN357, March 15, 2019, 10:58 and 47 seconds a.m. Answer. D. Variable life insurance allows the policy owner to decide how the cash value is invested, choice D, through a number of sub-accounts. With a whole life policy, all investment decisions are made by the insurance company. Variable life special features. U15L07, identify the special features applicable to a variable life policy. Variable life policy loans, like traditional WLI, a VLI contract allows the insured to borrow against the cash value that has accumulated in the contract. However, certain restrictions exist. Usually, the insured may only borrow a percentage of the cash value. The minimum percentage that must be made available is 75% after the policy has been in force for 3 years. If the death benefit becomes payable during any period that a loan is outstanding, the loan amount is deducted from the death benefit before payment. The interest rate charged is stated in the policy. Test topic alert. Several testable facts about policy loans are as follows. A minimum of 75% of the cash value must be available for policy loan after the policy has been in force 3 years. The insurer is never required to loan 100% of the cash value. Full cash value is obtained by surrendering the policy to the insurer. If the insured dies with a loan outstanding, the death benefit is reduced by the amount of the loan. If the insured surrenders the contract with a loan outstanding, cash value is reduced by the amount of the loan. Example 1. On July 15, 2015, your client purchased a variable life insurance policy with a death benefit of $500,000. The November 2017 statement showed a cash value of $30,000. If the client wanted to borrow as much as possible, the insurance company would have to allow a loan of at least $0, B $15,000, C $22,500, D $27,000. Answer: until a variable life policy is in force for a minimum of 3 years. This one is a bit less than 2.5 years. There is no requirement to make the loan provision available. Once the 3-year mark is reached, that minimum becomes 75% of the computed cash value. 358, Unit 15 Insurance-Based Products. S65_LEM.IN 358, March 15, 2019, 10:58 and 47 seconds a.m. Variable Life Insurance Contract Exchange. A unique feature of variable life insurance is the ability for the insured to have a change of heart. During the early stage of ownership, you have the right to exchange a VLI contract for a form of permanent insurance issued by the company with comparable benefits, usually whole life. The length of time this exchange privilege is in effect varies from company to company, but under no circumstances may the period be less than 24 months, federal law. The exchange is allowed without evidence of insurability. If a contract is exchanged, the new permanent policy has the same contract date and death benefit as the minimum guaranteed in the VLI contract. The premiums equal the amounts guaranteed in the new permanent contract, as if it were the original contract. Test Topic Alert. 3 testable facts about the contract exchange provision are listed here. The contract exchange provision must be available for a minimum of 2 years. No medical underwriting, evidence of insurability, is required for the exchange. The new policy is issued as if everything were retroactive. That is, the age of the insured as of the original date is the age used for premium calculations for the new policy. Variable life insurance voting rights. Unlike any other type of life insurance, variable life contract holders have voting rights. Contract holders receive 1 vote per $100 of cash value funded by the separate account. As with other investment company securities, changes in investment objectives and other important matters may be accomplished only by a majority vote of the separate account's outstanding shares or by order of the state insurance commissioner. Test Topic Alert. Do not confuse the voting rights of variable annuities and variable life. Variable annuities and mutual funds are the same, 1 vote per unit, share. Variable life is 1 vote per $100 of cash value. Unit 15. Unit 15 Insurance-Based Products, 359. S65_LEM.IN 359, March 15, 2019, 10:58 and 47 seconds a.m. S65_LEM.IN 360, March 15, 2019, 10:58 and 47 seconds a.m. This unit discusses both securities and non-securities derivatives. The term derivative is used to describe investment vehicles that derive their value from an underlying asset, whether that asset be a security, such as a stock, or a physical commodity, such as wheat. You can expect to see 5 questions about derivatives on the Series 65 exam. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U16L01, recognize the common characteristics of all derivatives. U16L02, identify the difference between a put option and a call option and their strategies. U16L03, contrast calls, rights, and warrants. U16L04, describe the difference between futures and forwards contracts. U16L05, identify the costs, benefits, and risks of derivative securities. Derivative securities, options. U16L01, recognize the common characteristics of all derivatives. Options are derivative securities. That means they derive their value from an underlying instrument, such as a stock, stock index, interest rate, or foreign currency. Option contracts offer investors a means to hedge or protect an investment's value or speculate on the price movement of individual securities, markets, foreign currencies, and other instruments. An option is a contract that establishes a price and time frame for the purchase or sale of a particular underlying instrument. 2 parties are involved in a contract, one party receives the right to exercise the contract to buy or sell the underlying asset. The other is obligated to fulfill the terms of the contract. 16. Unit. Types and characteristics of derivative securities. 361. S65_LEM.INF361 March 15, 2019, 10:58 and 47 seconds a.m. In theory, options can be created on any item with a fluctuating market value. The most familiar options are those issued on common stocks. They are called equity options. The exam is going to deal solely with standardized options traded on an exchange such as the Chicago Board Options Exchange or NASDAQ. They are called standardized options because each options contract has three standardized terms. The underlying asset. That is, all options on XYZ stock are for 100 shares of the XYZ common stock. The expiration date. All options that expire in June or July or whatever month have the same date and time of expiry. The exercise or strike price. Strike prices are set at standardized intervals. It is this standardization that makes secondary trading in options possible. Example. 1. Your customer is long 10 ABC July 50 calls at 4.50. How many shares of stock will change hands if the option is exercised? A. 10. B. 100. C. 1,000. D. 10,000. Answer. C. One of the three standardized terms of equity options is that each contract is for 100 shares. Therefore, the exercise of 10 calls, or puts, for that matter, will involve 10 by 100 or 1,000 shares. Choice C. Later in this unit, we will discuss non-securities derivatives, forwards and futures contracts. These derive their value from an asset that is not a security, most commonly a commodity. The concept is the same. There are two parties, a buyer and a seller, and can be used by speculators or those who wish to protect, hedge. The two most important factors influencing the price of a derivative are the price movement of the underlying asset and the length of time until the contract expires. The longer the time, the greater the time value. Puts and calls. U16L02. Identify the difference between a put option and a call option and their strategies. There are two types of option contracts, calls and puts. A call option gives its holder the right to buy a stock for a specific price within a specified time frame. A call buyer buys the right to buy a specific stock, and a call seller takes on the obligation to sell the stock. A put option gives its holder the right to sell a stock for a specific price within a specified time frame. A put buyer buys the right to sell a specific stock, and a put seller takes on the obligation to buy the stock. 362 Unit 16 Types and Characteristics of Derivative Securities. S65_LEM.INF362 March 15, 2019, 10:58 and 47 seconds a.m. Each stock option contract covers 100 shares, a round lot of stock. An option's cost is its premium. Premiums are quoted in dollars per share. Example, because a contract covers 100 shares, a premium of $3 means $3 for each share multiplied by 100 shares, which equals $300. Example 1. Which of the following statements regarding derivative securities is not true? A. Derivatives can be sold on securities and non-securities. B. An option contract is a derivative security because it has no value independent of the value of an underlying security. C. An option contract's price fluctuates in relationship to the time remaining to expiration as well as with the price movement of the underlying security. D. An owner of a put has the obligation to purchase securities at a designated price, the strike price, before a specified date, the expiration date. Answer. D. An owner of a put has the right, not the obligation, to sell, not purchase, a security at a designated price, the strike price, before a specified date, the expiration date. That makes choice D the untrue statement. It is only the seller of an option who has an obligation. Here is another way that point might be asked. Example 1. Choose the term that best describes the following situation. A customer has the right to sell 100 shares of MNO at 60 any time between July and October. A. Long call. B. Long put. C. Short call. D. Short put. Answer. B. The put buyer, long position, has the right to sell stock to a put writer who is obligated to buy that stock. Choice B. Option transactions, because two types of options, calls and puts, and two types of transactions, buying and selling, exist. For basic transactions are available to an option investor. Buy calls, sell calls, buy puts, sell puts. Unit 16. Unit 16 Types and Characteristics of Derivative Securities, 363. S65_LEM.INF 363 March 15, 2019, 10:58 and 47 seconds a.m. Option buyers are long the positions, option sellers are short the positions. An option conveys rights and obligations for a limited time. Therefore, each transaction has a beginning and an end, an open and a close. For instance, an option position opened by an investor buying a call is closed when the call is exercised, is sold, or expires. An option position opened by an investor selling a call is closed when the call is exercised, is bought, or expires. The owner, long position, of a put or call option contract has three ways to close a position. Sell the option contract before the expiration date. Exercise the option to buy or sell the security specified in the contract, or let the option expire. The simplest and most common way to close an option position is entering the transaction opposite of the opening transaction. The following table summarizes potential opening and closing positions. Open to close, by call, sell call, sell call, by put, sell, put by put. Exercising an option. In some cases, the holder of the option, only owners can exercise, it is one of their rights, will decide to exercise the option. Exercising a call means purchasing the underlying stock at the strike price. Exercising a put means selling the underlying stock at the strike price. For example, if you were long an ABC 50 call and the current market price of ABC is 60, you would be able to exercise and purchase stock worth $60 per share at the exercise price of $50. Or, if you are long an XYZ $45 put and the current market price of XYZ is $35, you might wish to purchase 100 shares of XYZ at $35 per share and then exercise your option to put the stock at $45. The test may ask you the difference between American and European style exercises. American style means the option can be exercised at any time the holder wishes, up to the expiration date. European style options may only be exercised on the last trading day before the expiration date. Take note. A tool for remembering the difference between American and European exercise is to look at the first letter. A for American means any time. E for European means expiration date. Test topic alert. Now that you have become so focused on the exercise date differences between American and European styles, be prepared for a question stem like, a European option is a derivative because, and the first answer choice will probably be, it can only be exercised on the expiration date. Although that is true about exercise, it. 364 Unit 16 Types and Characteristics of Derivative Securities. S65_LEM.INF 364 March 15, 2019, 10:58 and 48 seconds a.m. Has nothing to do with why options are derivatives. Please select an answer choice similar to, its value is based on some underlying asset. Take note. Perhaps you noticed an inconsistency. First, we told you that European style means the option can only be exercised on the day prior to its expiration date. Then, we told you it is only exercised on its expiration date. In the industry, there seems to be much confusion about this, and for exam purposes, either statement is correct, and you won't have to choose between them. Length of an option contract. Options are available that are issued with an expiration date of as short as 1 week to as long as 3 years. The short ones are called weeklies SM, and the long-term are known as LEAPs, long-term equity anticipation securities. Most standard options are issued with expiration days of a maximum of 9 months. Test topic alert. You must remember that all options, regardless of their length, are derivative securities. Options Greeks. Many of our students tell us that when it comes to understanding options, it is all Greek to me. Maybe that is why options strategists use a number of Greek letters to describe various properties of an option. There are 4 commonly used Greeks: delta, gamma, theta, and vega. It is highly unlikely that you will have to know anything about them, but we've given a short definition of each in the glossary. Option strategies. Option strategies are either bullish or bearish positions on the underlying stock. Bulls believe the price of a security will go up, and bears believe the price of a security will go down. The primary reasons for buying or selling options are to profit from or hedge, protect, against price movement in the underlying security. A bullish investor may buy calls seeking profit if the price of the underlying stock rises. A bearish investor buy puts seeking profit if the price of the underlying stock declines. Likewise, a bullish investor may write, sell, puts which will make money if the stock price is stable or rises, and a bearish investor may write, sell, calls which will make money if the stock price is stable or declines. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 365. S65_LEM.N365 March 15, 2019, 10:58 and 48 seconds AM. Figure 16.1, Bullish and Bearish Options Positions. Right to buy bullish obligation to sell bearish. Right to sell bearish obligation to buy bullish. Long. Calls. Puts. Short. Buyer, holder, owner, seller, writer, grantor. Take note. A phrase that is invaluable for figuring out options questions is call up and put down. That is, you would buy a call because you are hoping or are afraid the price of the stock will go up, and buy a put because you are hoping or are afraid the price of the stock will go down. Buying calls. Investors expecting a stock to increase in value speculate on that price increase by buying calls on the stock. By buying a call, an investor can profit from the increase in the stock's price while investing a relatively small amount of money. The most a call buyer can lose is the money paid for the option. The most a call buyer can gain is unlimited because there is no limit to how high the stock price can go. Owners of options, puts or calls, do not receive dividends on the underlying stock. As we will show you in Unit 20, buying calls is also a hedging, protection, strategy when the investor is afraid the stock price will rise. Test topic alert. Remember those employee stock options we discussed in Unit 12? No, they are not at all like these puts and calls, but the employer, the company issuing the stock, might want to use call options to protect against market risk. You see, when granting employees the option, the right, to buy shares at a set price, the company is obligated to deliver the shares at that agreed-upon price. What happens if the company's stock price soars, the employees exercise their options, and the company has to go out into the stock markets and buy stock at a price far in excess of what they're going to be selling it for? That hurts. One way to protect themselves is to buy call options on the stock so that if this were to happen, they could use their options to buy the stock at whatever exercise price was part of the contract. Writing calls. A neutral or bearish investor can write, sell, a call and collect the premium. An investor who believes the stock's price will stay the same or decline can write a call to generate income from the option premium. 366 Unit 16 Types and Characteristics of Derivative Securities. S65_LEM.N366 March 15, 2019, 10:58 and 48 seconds AM. Partially protect, hedge, a long stock position by offsetting any loss on the sale of the stock by the premium amount, or if the stock price increases, the call may be exercised. In addition to the premium received when the option was sold, the writer will be paid the strike price for the stock. If the option writer owns the stock on which the call is being written, it is known as a covered call and the risk is limited, because no matter how high the stock price rises, meaning the call will certainly be exercised, the writer merely uses the stock already owned, which has been deposited with the broker-dealer, to make delivery. However, if the writer does not own the stock, the option is uncovered, usually referred to as naked in the industry. That's when the risk is unlimited, because the writer must pay the going market price, and there is theoretically no limit as to how high a stock's price can go to acquire the stock needed to fulfill the obligation to deliver. That is why naked call writing is the most risky option strategy. Buying puts. A bearish investor, one who believes a stock will decline in price, can speculate on the price decline by buying puts. A put buyer acquires the right to sell 100 shares of the underlying stock at the strike price before the expiration date. Example. Here is how that might work. An investor following ABCD common stock believes that it is grossly overpriced at $75 per share, and when the next earnings report is released, the stock will drop at least 10 points. If the investor were to purchase an ABCD 75 put for a premium of $3 and was correct, once the stock was at $65, the 10-point drop, a purchase could be made at that price for $65 per share, and then the put could be exercised at the $75 per share strike price. This would give the investor a profit of $7 per share, the $10 difference between the cost of $65 and the sale at $75, minus the $3 premium paid. A $700 profit on a $300 investment is a very handsome percentage return on investment. As we will show you in Unit 20, buying puts is also a hedging, protection, strategy when the investor is afraid the stock price will fall. Writing puts. Generally, investors who write puts believe that the stock's price will rise or remain stable. A put writer, seller, is obligated to buy stock at the exercise price if the put buyer puts it to the put writer. If the stock's price is above the put strike price at expiration, the put expires unexercised, allowing the put writer to keep the premium. Just as with writing calls, receiving that premium is a source of income. Put writers will lose if the stock price falls, the buyer wins, but the loss is limited because the stock price can never fall below zero. Straddles. When an investor is not sure which direction the market will move, but has a strong opinion that there will be dynamic movement, a strategy that might be employed is the purchase of a straddle. This is the combining of a put and a call on the same stock with the same exercise price and expiration date. If the stock moves up, a profit is made on the call. If down, a profit is made on the put. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 367. S65_LEM.INF 367 March 15, 2019, 10:58 and 49 seconds AM. Test Topic Alert. Those who buy a straddle will profit from volatility, while those who sell a straddle will profit if the market is stable because the options will expire unexercised. Rights and warrants. U16LO3, contrast calls, rights, and warrants. Although generally treated as equity securities, in truth, rights and warrants are derivatives because their value is derived from the common stock which they may acquire by exercising that right or warrant. Because rights and warrants give the holder the option, but not the obligation, to buy a stock at a specific price during a specific time period, they can be compared in most respects to a call option. There are some differences, however. Let's start with rights. Rights, sometimes referred to as preemptive rights, are a privilege extended to existing holders of a company's common stock. When a company is going to issue additional shares of common stock, to prevent dilution of ownership by the current owners, they are given the right to preempt, come ahead of any members of the general public and have the first shot at the new stock. The right permits them to purchase enough shares to keep their proportionate interest in the company. Here is a very simple example. Steve has 100 shares of DEF Corporation common stock. DEF has 10,000 shares of stock outstanding, so it is clear that Steve owns 1% of the company. 100/10,000 equals 0.01. DEF wishes to raise additional capital by issuing 5,000 new shares of stock. Steve will receive rights to purchase how many of those 5,000 shares? In order to keep his 1% ownership, Steve will receive stock rights to purchase 50 shares of the new issue. As an incentive, rights offerings always have an exercise price slightly below the current market price of the existing stock. Also, because the company needs to raise the money, they limit the time in which you have to decide to exercise your right, usually no more than 45 to 60 days. If Steve decided he did not want to exercise his rights, he could sell them, and because the exercise price is below the market price, they would have a value. The key points to remember about rights are the following. They are given, not sold, to existing holder of the common stock. They are exercisable at a price below the current market. They have a short lifespan. They will expire in 45 to 60 days. They can be sold and then the buyer can exercise them. Although generally unwise to do, they can be left to expire. Warrants. Unlike rights, warrants have an exercise price above the current market price and, again, unlike rights, warrants have no relationship to an existing stockholder's proportionate interest. Another difference is that warrants have a long expiration period, sometimes as much as 10 years or even longer. They are usually attached to a bond issue. Their attractiveness sweetens the issue, frequently allowing for a lower interest rate on the bond, or attached to a new stock. 368 Unit 16 Types and Characteristics of Derivative Securities. S65_LEM_ Chapter 16. I'm 368 October 7, 2019, 10:56 and 39 seconds a.m. Offering where the package is considered a unit, such as one share of stock with a warrant to purchase another share. In most cases, the warrants can be detached and sold separately. The key points to remember about warrants are: they are exercisable at a price above the current market. Why would anyone be interested in that? Because you might have a 5-year expiration period and have the right to buy the stock at $45 when it is selling at $40 today. If you think there is a chance that the stock's price will move more than 5 points in 5 years, you can make money, sometimes lots of money, because of the leverage. This is known as having time value. Their life is considerably longer than rights and longer than call options as well. When detached, they can be traded like any other security. They are usually traded on the same exchange as the company's common stock. Most securities professionals view warrants as call options with a very long time to expiration. Warrants do not have voting rights, the same as any other derivative. One major difference between call options and rights/warrants is that options originate on the exchange on which they are traded, where rights and warrants originate with the issuer of the stock. The effect of this is that new shares are issued when a right or warrant is exercised, while exercise of a call option requires the assigned seller to deliver existing shares. Example: 1. Gemco Manufacturing Company, traded on the NYSE, has announced that it will be issuing 10 million new shares of common stock to raise new capital for the purchase of new equipment. Your client owning 1,000 shares of Gemco common stock would probably receive an advance invitation to purchase some of the new shares. B. Options to purchase some of the new shares. C. Preemptive rights to purchase some of the new shares. D. Warrants to purchase some of the new shares. Answer: C. Commonly, when a publicly traded company issues new shares of common stock, existing shareholders receive rights, sometimes called stock rights, enabling them to purchase shares in proportion to their current ownership, usually at a reduced price, choice C. These rights rarely last longer than 45 days and must be exercised or sold within that time, or they'll just expire worthless. Warrants are not sent to shareholders. They are either purchased in the open market or come attached to a new issue of securities as a sweetener. Unit 16. Unit 16 Types and Characteristics of Derivative Securities, 369. S65_LEM.INF 369 March 15, 2019, 10:58 and 49 seconds a.m. Non-securities derivatives, forward contracts. U16L04, describe the difference between futures and forwards contracts. Forward contracts. Forward contracts were developed as a means for commodity users and producers to arrange for the exchange of the commodity at a time agreeable to both. Used in Europe as early as the Middle Ages, typically for agricultural items, grains, and so forth, forward contracts evolved to eliminate the problem of finding a buyer or seller for an upcoming cash market transaction. They also reduce the price risk inherent in changing supply and demand relationships. How so? Because the seller knows exactly how much he will receive for his product. Of course, he may wind up contracting to sell too cheaply if market prices at delivery are much higher, but he is protected against receiving too little if the harvest is plentiful and prices plunge. A forward contract is a direct commitment between one buyer and one seller. If the position is held until the closing date, the forward seller is obligated to make delivery, the forward buyer is obligated to take delivery. A forward contract is non-standardized. Its unique terms are defined solely by the contract parties, without third-party intervention. This arrangement ensures a ready market or supply source because it presumes delivery. Because forward contracts are direct obligations between a specific buyer and seller, the user and producer, they are not easily transferred and are considered illiquid. There is no secondary market for forward contracts. Further, each party risks the credit and trustworthiness of the other. The 5 components of a typical forward contract are: quantity of the commodity, quality of the commodity, time of delivery, place for delivery, and price to be paid at delivery. Futures. In contrast to forward contracts, futures contracts are exchange-traded obligations. The buyer or seller is contingently responsible for the full value of the contract. A buyer goes long, or establishes a long position, and is obligated to take delivery of the commodity on the future date specified. A seller goes short, or establishes a short position, and is obligated to deliver the commodity on the specified future date. If the seller does not own the commodity, his potential loss is unlimited because he has promised delivery and must pay any price to acquire the commodity to deliver. As prices change, gains or losses are computed daily for all open futures positions on the basis of each day's settlement price. Gains are credited and losses are debited for each open position, long or short. All accounts for firms and traders must be settled before the opening of trading on the next trading day. Buyers and sellers benefit from organizations that act as clearinghouses for the contracts. Clearinghouses enable futures positions to be offset easily before delivery. To offset, close, or 370 unit 16 types and characteristics of derivative securities. S65_LEM.INV 370 March 15, 2019, 10:58 and 49 seconds AM. Liquidate a futures position before delivery. An investor must complete a transaction opposite to the trade that opened the futures position. The offsetting transaction must occur in the same commodity, for the same delivery month, and on the same exchange. About 98% of futures contracts are offset before delivery. Futures may be highly leveraged. If, at expiration, the settlement price is higher than the delivery price, a long position results in a profit while a short position loses. Conversely, if the settlement price is lower than the delivery price, shorts profit and longs lose. Typically, there are 5 standardized parts to an exchange-traded futures contract. Quantity of the commodity, example, 5,000 bushels of corn or 100 ounces of gold. Quality of the commodity, specific grade or range of grades may be acceptable for delivery, including price adjustments for different deliverable grades. Delivery price, similar to exercise or strike price with options. Time for delivery, example, December wheat to be delivered. Location, approved for delivery. Test topic alert. Futures are most commonly used by speculators, while forwards are used by producers. That explains why such a small percentage of futures contracts ever end with delivery. Example 1. Forwards are commonly used by producers, farmers, to hedge the risk of the price of the commodity falling before it is able to be harvested and sold. For example, if a farmer has planted soybeans and wishes to hedge against a possible decline in the spot or cash price at delivery, the farmer could A. buy forward contracts in a size equal to the amount of soybeans expected to be harvested. B. buy futures contracts in a size equal to the amount of soybeans expected to be harvested. C. sell futures or forward contracts in a size equal to the amount of the soybeans expected to be harvested. D. sell the soybeans for cash today. Answer. C. Hedging a commodity yet to be harvested is done by selling a forward or a futures contract on that commodity. In that way, the price is guaranteed in the event of a market decline. However, the producer is giving up any potential gain in the event the prices rise above the futures/forward agreed upon. 1. Regulation of futures and forwards. Because these are not securities, they do not come under the jurisdiction of the SEC. The SRO that is in charge of regulating the futures markets and their participants is the Commodity Futures Trading Commission, CFTC. Forward contracts are not regulated by any agency. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 371. S65_LEM.INF 371 March 15, 2019, 10:58 and 49 seconds a.m. Example. 1. Commonly traded on a regulated exchange would be any of the following except A. ETFs. B. Forward contracts. C. Futures. D. Warrants. Answer. B. A forward contract, choice B, is a direct commitment between one buyer and one seller. This makes each contract different, and lack of standardization makes exchange trading a virtual impossibility. Investing in derivatives. U16L05, identify the costs, benefits, and risks of derivative securities. Using derivatives can be a useful strategy for investors if the circumstances warrant it. There is no cost, per se, to open an options account, although, as we will learn in Unit 18, the account opening procedure is somewhat more involved than opening a regular account at a broker-dealer. For those who buy options, long position, the only cost is the premium to purchase the option, plus whatever the brokerage firm charges in commissions. With a very limited, and probably not tested, exception, options cannot be purchased on margin, covered in Unit 22, so, without any borrowed money, no interest is charged. Selling options, short position, brings in money from the sale and the seller receives all of that premium, less the brokerage charges. If the call or put being written, sold, is uncovered, there is a margin requirement, but that is beyond the scope of the exam. The cost to carry forwards and futures is much more complicated, and we are not aware of the topic ever being tested. As with any investment, there are benefits and risks. We'll look at those most likely to be on your exam. Leverage. One of the key benefits to using derivatives is that of leveraging your investment. Because an options cost is normally much less than the underlying stock's cost, option contracts provide investors with leverage. Relatively little money allows an investor to control an investment that would otherwise require a much larger capital outlay. And, if you purchase a call and guess right, the potential profit is unlimited. Theoretically, there is no limit as to how high the stock's price can go. Example, an investor can buy the common stock of RST Corporation for $58 per share, investing $5,800, or buy an RST55 call for $6, an investment of $600. If RSTs. 372 Unit 16 Types and Characteristics of Derivative Securities. S65_LEM.INF 372 March 15, 2019, 10:58 and 49 seconds a.m. Price increases to $70, the stock investor will see a 20.7% profit, $12 profit / $58 investment, whereas the option investor, with the call worth a minimum of $15, $70 minus $55, will have more than doubled the investment, $9 profit / $6 investment equals 150%. The opposite is also true. If RST trades below $55, say at $48, when the option expires, the stock investor has a modest loss, but the option investor loses the entire investment. What is the value of an option to buy stock at $55 per share when it is currently available to anyone at $48? Nothing. As you can see from the example, leverage works both ways, great when the stock is going your way, and a possible loss of everything when it doesn't. Of course, if, in the following example, RST had gone bankrupt leaving the stock worthless, the investor holding 100 shares would have lost the entire $5,800 while the option investor's loss would have been limited to the $600 premium paid. Less risk. When used properly, options can lower an investor's risk. The classic example is the covered call, where the investor owns the stock and then writes a call option on it. Realize that there are only three things that can happen after you purchase a stock. The stock can increase in price. The stock can remain stable. The stock can decline in price. If you think about it, two of those possibilities are unfavorable. Certainly, you don't want the stock to fall in price. Even if the stock remains level, you've suffered from opportunity cost. You could have put it in the bank with no market risk and earned interest. Only if the stock increases by more than the risk-free rate do you emerge a winner. However, if you write a call on that stock, you wind up better for sure in cases 2 and 3, and perhaps even in case 1. Let's look at an example. Meredith purchases 100 shares of ABC at $50 per share. She then writes, sells, an ABC 50 call for a premium of $400. If the stock goes down to $47 by expiration date, the option she wrote will expire. Who is going to call on her to sell stock at $50 when it is available for $47 in the marketplace? In reality, though, she hasn't lost $300 because she received $400 when she sold the option. She is still $100 ahead of the game, even though the stock dropped in price. It isn't until the stock falls below $46 that she begins to lose money, but, no matter how far it falls, she will still be $400 ahead of having just bought the stock without selling the option. If the stock price remains the same, the option will expire, and she will still own the shares, but will have $400 in her account from the sale of the option. Only in the first choice is it possible for her to be a loser, but even that wouldn't happen until the stock rose above $54 per share. How is that? If the stock is $53, yes, her option will be exercised, and she will have to sell her stock at the strike price of $50. She paid $50 for it, but also received a $4 premium, so the total received on the sale of the stock plus the option is $54. Now, if the stock goes to $60, she would have been better off never writing the option. That is a risk you take in exchange for the chance that you'll win if the stock's price only rises a little, stays the same, or falls. Alternative to selling short. As we will learn in Unit 22, one way to make money when an investor is of the belief that a stock's price will decline is to sell that stock short. At this juncture, to keep things simple. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 373. S65_LEM.INF 373 March 15, 2019, 10:58 and 49 seconds a.m. Selling stock short involves putting up a deposit in a margin account, borrowing stock to sell, and carries with it the possibility of an unlimited loss. When you buy a put, you benefit when the stock's price declines, but all you pay is the premium and, if you guess wrong, that is all you can lose. Having just mentioned the possibility of an unlimited loss when an investor sells a stock short, we would be remiss if we didn't discuss the parallel situation with options. When an investor writes an uncovered, naked, call option, the potential loss is unlimited. Here is how that works. With the market price of ABC at $50 per share, Manny writes a 50 call option for a premium of $3. Manny does not own any ABC, but, as the seller of the call option, is obligated to deliver 100 shares of the ABC stock and receive $5,000 if the option is exercised. We use the phrase, call up, to help us remember our objective when we buy a call. If the price of ABC should go up, the option will be exercised and Manny will have to buy it at its current market price and then deliver it. The question is, how high can it go? Theoretically, and that's the exam view, there is no limit, it can rise to infinity. That leaves Manny having to pay an infinite amount to buy stock for which he receives only the $5,000 strike price, plus the $300 premium. Just in case you want to say, but, because he receives $5,300, his loss can't be unlimited. Remember, infinity minus any other number is still infinity. We know this is just theoretical, but, if you've watched some of the better-known companies over the past few years, some of the price increases have been astronomical. Hedging. In the example of writing the covered call, we showed one example of hedging, protecting a position. In that case, the first 4 points of a market decline were absorbed by the premium received from the sale of the call. There is more to discuss on using options to hedge, and we're going to cover that in Unit 20. Time decay. Have you ever heard an investor say, "I'm going to hold this stock until it gets back to what I paid for it"? We're not going to debate the logic of that statement other than to say, that doesn't work with options. They ultimately expire, and, if the stock hasn't moved in the direction you're hoping for, you will run out of time. Time decay is the concept that, as the time to expiration gets closer, the value of the option decreases. Taxation. In most cases, any profit realized from buying or selling options is treated as a short-term capital gain. As we will learn in Unit 21, those gains are taxed at ordinary income rates, which are much higher than the long-term capital gain rate. Much of what we've shown you here applies to forwards and futures as well, but other than some very basic questions, we don't expect the kind of detail we've presented here for options. Here's the type of question that is basically easy, but, if you don't read carefully, you will waste time trying to figure it out. 374, Unit 16 Types and Characteristics of Derivative Securities. S65_LEM.End 374, March 15, 2019, 10:58 and 49 seconds a.m. Examples. 1. Among the purposes of purchasing derivatives would be all of the following except A. Hedging, B. Income, C. Profits, D. Speculation. Answer. B. Purchase of a derivative, whether an option, a forward, or futures contract, never generates income. Selling one does, but the question refers to a purchaser, and that is why the correct answer is choice B. 2. The term derivative would not include A. Futures on commodities, B. Interest rate swaps, C. REITs, D. LEAPs. Answer. C. The derivative is something which derives its value from something else. REITs represent direct investment into real estate. The asset purchase is the actual asset, choice C. LEAPs are the options with the long-term expiry. Never heard of interest rate swaps? Well, on the real exam, there will occasionally be an answer choice that you've never heard of, but it should not affect your ability to choose the correct one. Unit 16. Unit 16 Types and Characteristics of Derivative Securities, 375. S65_LEM.End 375, March 15, 2019, 10:58 and 49 seconds a.m. S65_LEM.End 376, March 15, 2019, 10:58 and 50 seconds a.m. In the 1990s, financial advisors began introducing their wealthy clients to alternative investments, now generally referred to as ALTs. These included, among other products, exchange-traded notes, ETN, leveraged ETFs, and new, highly sophisticated financial derivatives. One thing that all of these had in common was that they were complex and not easy to understand, for both the investor and the person recommending the investment. Although investing can be complex, standard investments are fairly easy to comprehend. Even new investors understand that stocks have more risk, but hold out the chance of superior returns, while bonds generally have less risk with correspondingly lower returns. All investors dream of scoring a touchdown and not getting tackled for a loss. Alternative investments try to do just that. Some are successful, but many are not. Suitability determinations need to be made on a case-by-case basis, considering each customer's objectives, circumstances, and sophistication. Securities professionals must take special care in recommending these complex products to the sophisticated customer, and even more so to one with less financial acumen. In addition to alternative investments, the exam will test your knowledge on other more traditional assets, such as investment real estate and commodities, including precious metals. The Series 65 exam will include approximately 4 questions from this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U17L01, identify the concept of flow-through, pass-through, of passive income and loss as it applies to DPPs. U17L02, differentiate between the roles of the general partners and the limited partners in a DPP. U17L03, recognize the characteristics of the pooled investment vehicles that are considered alternative investments. U17L04, describe viatical/life settlements. U17L05, contrast the difference between passive and active real estate investing. 17. Unit. Alternative investments and other assets. 377. S65_LEM.INT377 March 15, 2019, 10:58 and 50 seconds a.m. U17L06, identify the different types of commodities and precious metals that are popular investments. U17L07, describe the benefits and risks of alternative investments. Direct participation programs, DPPs. U17L01, identify the concept of flow-through, pass-through, of passive income and loss as it applies to DPPs. This is one class of alternative investment. DPPs, most of which are limited partnerships, allow the economic consequences of a business to flow through to investors. Any income or loss to the investor is considered passive because the investor does not take an active role in the management of the business. That is the role of the general partner, as you will learn shortly. Unlike corporations, limited partnerships pay no dividends. Rather, they pass income, gains, losses, deductions, and credits directly to investors. Limited partnerships offer investors limited liability. Similar to a stockholder in a corporation, creditors cannot generally come directly to limited partners to collect on defaulted debt. In general, the maximum potential loss to a LP is the amount already invested plus any funds committed for which have not yet been submitted. Take note. In Unit 21, the topic of partnership taxation will be covered in greater detail, but, at this point, we want you to know that any income received by a partner is considered passive, and the same is true for losses. The effect of this is that any passive losses can only be deducted as a loss against passive income. Investors in a limited partnership. U17L02, differentiate between the roles of the general partners and the limited partners in a DPP. It is important to understand that a DPP is just a different way to invest in a business rather than buying the company's stock. There are certain tax advantages to being structured as a partnership with the flow-through of income or loss being one of them. That aside, this is merely an investment in a business, whether it be a RALP, real estate limited partnership, an oil and gas drilling program, or a movie production company. Just like any other business, there are those who run the enterprise, management, and those who contribute the capital, investors. For DPPs, those roles are assumed by the general partners, usually referred to as GP, and the limited partners, the LPs. From a legal standpoint, there must be at least one GP and one LP. Investing in a DPP requires analyzing the program just as one would analyze a stock or bond investment, just with a few different parameters. An investor should choose to invest in a specific limited partnership because it is economically viable. The investor can make use of the potential tax benefits. 378, Unit 17, Alternative Investments and Other Assets. S65_LEM.INT378 March 15, 2019, 10:58 and 50 seconds a.m. The GPs have demonstrated management ability and expertise in running similar programs. The program's objectives match the investor's objectives and do so within a time frame that meets the investor's needs, and the startup costs and projected revenues are in line with the startup costs and revenues of similar ventures. Promoters structure DPPs to meet various objectives. When a promoter's tax stance is too aggressive or is without economic purpose in the view of the IRS, the program is considered an abusive tax shelter. If the IRS judges the program to be abusive, it disallows deductions, assesses back taxes, interest, and penalties, and, in some cases, charges the promoter with criminal intent to defraud. Investors should try to match their current and future objectives with the program's stated objectives. Example: a person seeking current taxable passive income should not invest in an oil and gas exploratory drilling program. Why not? Because these programs drill where oil or gas has never been found before, exploratory, and have a low success rate. Even when they do hit, it may take years before any income is generated. Take note. Because most of these are privately placed, DPPs are considered illiquid, and investors must commit money for a long time. Even those which are publicly traded do not have the liquidity of other investments, frequently requiring authorization from the GP to be able to sell your units. General Partner, GP. The GPs are the active investors in a limited partnership and assume responsibility for all aspects of the partnership's operations. A GP makes decisions that bind the partnership, buys and sells property for the partnership, manages the partnership property and money, supervises all aspects of the partnership's business, and maintains a minimum 1% financial interest in the partnership. Unlike LPs, who have limited liability, GPs assume unlimited liability and are therefore personally liable for all partnership business losses and debts. A partnership's creditors may seek repayment from the GPs and may go after their personal assets. A general partner has a fiduciary relationship to the LPs in that the GP has been entrusted with the LP's capital and is legally bound to use that capital in the investor's best interests. The GP must manage the business in the partnership's best interest and avoid the appearance of improper use of assets and conflicts of interest. The GP cannot borrow from the partnership, compete with the partnership, or commingle personal funds with partnership funds. Finally, GPs do not generally receive any distributions from profits until after a payment has been made to the LPs. Unit 17. Unit 17, Alternative Investments and Other Assets, 379. S65_LEM.IN 379, March 15, 2019, 10:58 and 50 seconds a.m. Limited Partner, LP. LPs are passive investors with no management or day-to-day decision-making responsibilities. Therefore, they usually are not held personally responsible for the partnership's indebtedness. In fact, if an LP does take an active role, she faces the danger of losing the limitation on liability. LPs may receive cash distributions and capital gains from partnerships. The total yield of a partnership investment takes into account all potential rewards, tax deductions, cash distributions, and capital gains. Units of ownership in a partnership are called interests rather than shares. Example: 1. In a direct participation program, liability for the debts of the business falls upon the A. General partners, B. Limited partners, C. Shareholders, D. Agents selling the program. Answer: as DPPs consist of at least one GP and one LP. The liability of the LPs is limited to their investment, including commitments made but not yet fulfilled. On the other hand, the GPs, choice A, bear the liability for the debts of the entity. Issuing partnership investments. DPPs may be offered either as private placements, qualifying for an exemption from registration under state and federal law as described in Unit 4, or publicly registered either with the SEC, the states, or both. In either case, specialized documentation known as a subscription agreement is required from investors. An investor who buys a limited partnership unit must complete and sign a subscription agreement, which includes a statement of the investor's net worth and annual income and a power of attorney form appointing the GP as the agent of the partnership. The agent is responsible to make certain that the information the potential investor provides in the subscription agreement is complete and accurate. U17LO3 recognize the characteristics of the pooled investment vehicles that are considered alternative investments. The category of ALTs also includes a number of pooled investment vehicles. Probably the best known is the hedge fund, covered Unit 14, but there are a number of others. The following is a description of the pooled investment vehicles considered alternative investments that are most likely to appear on the exam. Exchange-traded notes, ETNs. Although similar in some regards, don't confuse ETFs with ETNs. It could be said that ETNs are cousins of ETFs. That said, just as with family members, there are some important differences. Most obvious is the difference in their basic structure. While ETNs are registered, 380 Unit 17 Alternative Investments and Other Assets. S65_LEM.IND 380 March 15, 2019, 10:58 and 50 seconds a.m. Under the Securities Act of 1933, ETFs register under the Investment Company Act of 1940. Basically, this means that ETNs are made as debt instruments, while ETFs are looked at as investment companies. ETNs are a type of exchange-traded debt security offering a return linked to a market index or other benchmark rather than periodic interest payments, as is the case with traditional debt securities. These are sometimes referred to as equity-linked notes, ELNs, which is a real misnomer because they are debt securities. Issuers of ETNs issue and redeem notes as a means to keep the ETN's price in line with a calculated value, called the indicative value or closing indicative value for ETNs. This value is calculated and published at the end of each day by the ETN issuer. When an ETN is trading at a premium above the indicative value, issuing more notes to the market can bring the price down. Similarly, if an ETN is trading at a discount, redemption of notes by the issuer reduces the number of notes available in the market, which tends to raise the price. ETN issuers have primary control over the issuance and redemption processes, which can become a conflict of interest. Unlike ETFs, they do not buy or hold the assets replicating the performance of the underlying index. Some of the indexes and investment strategies used by ETNs can be sophisticated and very complex, carrying many different risks. They should be offered only to people who are knowledgeable and comfortable with the risks. Those risks, in part, include credit risk. ETNs are unsecured debt obligations. Market risk. Liquidity risk. Although exchange-traded, a trading market may not develop. Call, early redemption, and acceleration risk. ETNs may be called at the issuer's discretion, and conflicts of interest. The issuer may engage in trading activities that are at odds with note holders, shorting, for instance. Leveraged ETFs. These funds attempt to deliver a multiple of the return of the benchmark index they are designated to track. For instance, a 2x leveraged fund would try to deliver 2 times the return of whatever index it is tracking. With leveraged funds, there are no limits by rule or regulation as to the amount of leverage that could be applied to a portfolio. Currently, there are numerous 2x and 3x leveraged funds available to investors. The risk associated with leverage is that it is always a double-edged sword. Volatility is magnified. Therefore, the risk to be recognized regarding this fund strategy is that if the benchmark index is falling, then the fund's returns will be, in theory, the designated leverage amount, perhaps 2 or 3 times the loss. In addition, most of these funds use derivatives products such as options, futures, and swaps to enable them to achieve the stated goal. Because these derivative products are not suitable for all investors, so too can it be said of the leverage fund portfolio containing them. Ultimately, as always, suitability becomes an issue when recommending these products. Inverse, reverse, funds. Inverse funds, sometimes referred to as short funds, attempt to deliver returns that are the opposite of the benchmark index they are tracking. For example, if the benchmark is down 2%, the fund's goal is to be up 2%. As with leveraged ETFs, tools used to achieve the goal are options and other derivatives. In addition, inverse funds can also be leveraged funds, or said another way, 2 or 3 times the opposite of the indice's return. Unit 17. Unit 17, Alternative Investments and Other Assets, 381. S65_LEM.INV 381 March 15, 2019, 10:58 and 51 seconds a.m. Example. A simple example of this would be an inverse fund tracking the S&P 500. If the index were to drop by 1%, the value of the inverse fund would rise by 1%. If this was a 3x inverse fund, then the fund's value would rise by 3%. Of course, if the index were to rise, the performance of the inverse fund would suffer, especially if it was leveraged. Test topic alert. FINRA warns investors that most leveraged and inverse ETFs reset daily, meaning that they are designed to achieve their stated objectives on a daily basis. Their performance over longer periods of time, over weeks or months or years, can differ significantly from the performance or inverse of the performance of their underlying index or benchmark during the same period. Therefore, in most cases, these would not be suitable investments for buy and hold investors or those with other than a very short time horizon. For the TVX, Velocity Shares Daily 2X VIX CATN, one of the risk disclosures, page 28, PS 28, reads like this. The long-term expected value of your ETNs is 0. If you hold your ETNs as a long-term investment, it is likely that you will lose all or a substantial portion of your investment. Take note. Both leveraged and inverse index funds, leveraged or not, can be traded on an exchange. When they are known as ETFs. If the shares are exchange-traded, they are priced by supply and demand, can be purchased on margin, and bought and sold throughout the trading day, like all exchange-traded products. For those that are not exchange-traded, example, inverse mutual funds, they would be priced, purchased, and redeemed like all investment company shares. Neither of these fund types carry any guarantee that they will achieve the stated goal or objective. Structured products. When you need something that doesn't yet exist, what do? You build it. That is the concept behind structured products. They are built, structured, to meet specific needs. In many cases, they involve structuring a debt issue in such fashion as to provide lower borrowing costs to the issuer while increasing potential returns to the lender. The goal is to give investors more reasons to accept a lower interest rate on debt in exchange for certain features. In other examples, options and other derivatives are used to provide possible principal protection or other goals. Needless to say, for the most part these are highly complex products and should be limited to those investors who have the necessary financial sophistication to be able to understand the potential risks. When used properly, they can be useful tools to increase portfolio diversification. 382 Unit 17 Alternative Investments and Other Assets. S65_LEM.INV 382 March 15, 2019, 10:58 and 51 seconds a.m. Structured notes with principal protection. FINRA defines the term structured note with principal protection as any structured product that combines a bond with a derivative component and that offers a full or partial return of principal at maturity. Structured notes with principal protection typically reflect the combination of a zero-coupon bond, which pays no interest until the bond matures, with an option or other derivative product whose payoff is linked to an underlying asset, index, or benchmark. These notes are promises to pay made by the product issuers. That is why any guarantee that the principal will be protected, whether in whole or in part, is only as good as the financial strength of the company that makes that promise. For those who can remember, this is what happened to investors who purchased structured notes with principal protection issued by Lehman Brothers Holdings, which declared bankruptcy in September 2008. Risks of structured products. There are several risks involved with structured products. Because of the customized nature of these products, there is little or no liquidity. Secondly, in most cases, these are structured so that the returns are not fully realized until maturity. As a result, these should appeal to buy and hold investors rather than short-term traders. There is also the matter of credit risk, so it is important to know the strength of the financial institution who is the issuer. Finally, as with most alternative investments, there is a lack of efficient pricing. That is, the actual market price does not necessarily reflect the real value. This can lead to abnormal returns, good and bad. When good, the portfolio will generate positive alpha. When bad, the alpha will be negative. Viatical/life settlements. U17L04, describe viatical/life settlements. The terms viatical and life settlement are often used interchangeably, but they are technically not quite the same. The most significant and testable difference is that viaticals apply to those with a terminal illness and a life expectancy of 24 months or less regardless of their age, while life settlements apply to those who, although generally at least 65 years old, are in decent health with a life expectancy of at least 2 years that can run 10 years or longer. Health and life expectancy aside, the concepts are the same for both. In general, almost any kind of life insurance policy can be sold, although most companies will not purchase a straight, non-convertible, term life policy. Viatical settlements emerged in the early 1990s in response to the AIDS crisis to create opportunities for terminally ill patients to receive money by selling their life insurance death benefits for much more than the cash surrender value available, but less than the death benefit, from insurance companies. The idea is that the money the person gets from the settlement is to go toward paying for medical expenses during this 2-year period. Interests in the settled insurance policies are then sold to investors, with the promise of returns in the form of the death benefit, an amount higher than the purchase price, to be paid upon the death of the insured. As the market has expanded, viatical settlement providers turn to new classes of viators, those selling their life insurance policies, including the elderly and the chronically ill. Selling a life insurance policy, or the right to receive the death benefit, to any person other than the insurance company that issued the policy, is a transaction known as a viatical or Unit 17. Unit 17, Alternative Investments and Other Assets, 383. S65_LEM.INF 383, March 15, 2019, 10:58 and 51 seconds a.m. Life settlement. NSAA concludes that these settlements, regardless of the health status or age of the insured, are securities. All persons involved in the offer and/or sale of viatical or life settlements should be aware of the nature and extent of the registration and anti-fraud provisions of state securities laws, as well as the applicability of these provisions to every offer and/or sale of a security. Because licensing is done on a state-by-state basis, there is little uniformity. Some states require just a life insurance license, some require both a life insurance and a life settlement license, and some require either or both of these and being licensed as a securities agent. As with so much else, the regulators are concerned about suitability and disclosure. When a life insurance policy is sold to an investor, the buyer is acquiring a financial interest in the insured's death. In addition to paying a lump sum, the purchaser agrees to pay any premiums that are necessary to support the cost of the policy for as long as the insured lives. In exchange, the buyer will receive the death benefit upon death of the insured. It is important to be aware of the risks involved in this activity. Because there is no active secondary market for these policies, it is difficult to arrive at a fair evaluation, and the investor may wind up paying too much for the policy. There is always the chance that the insured will live longer than anticipated. The more the insured's life exceeds the projected expectancy, the lower the return to the investor. The possibility, remote as it is, that the insurance company will not be financially able to honor the claim. The intangible moral issue of the investor knowing that the sooner the insured dies, the greater the return. Investment real estate. U17L05, contrast the difference between passive and active real estate investing. We have already discussed two methods of passive real estate investing. That is, investing in real estate where all of the work is done for the investor. That is the case with the REIT and the Real Estate Limited Partnership Investment, RELP. Investing in real estate, whether it be single-family homes to flip or to rent, or commercial property, involves work on the part of the investor. Whether it is collection of rents, finding tenants, or doing repairs, the investor is responsible for doing the work or hiring someone to do it. One feature of real estate investment that is similar to the Section 1035 exchange available to annuities is the Section 1031 for real estate. An investor holding real estate may exchange that for another parcel, and there are no immediate tax consequences. Commodities. U17L06. Identify the different types of commodities and precious metals that are popular investments. In the previous unit, we discussed futures. They are one of the methods by which individual investors can invest directly in commodities. Forwards are used primarily by producers and industrial consumers. One can also invest indirectly through ETPs, exchange-traded products, such as ETFs that follow a commodity index, or mutual funds that invest in 384 Unit 17 Alternative Investments and Other Assets. S65_LEM.INF 384 March 15, 2019, 10:58 and 51 seconds a.m. Commodity-related businesses. For instance, an oil and gas fund would own stocks issued by companies involved in energy exploration, refining, storage, and distribution. Historically, most commodity trading was of agricultural products. We were an agrarian society, and these commodities, such as corn, wheat, oats, and soybeans, are still actively traded. There are animal-based commodities, such as beef, pork, and eggs. Today, the most commonly traded commodity is crude oil, with coffee often claimed to be in second place. And, of course, for all of you Eddie Murphy fans, remember the movie Trading Places. There are frozen orange juice futures. Active trading also takes place in industrial metals, such as aluminum, nickel, copper, and lead. Speaking of metals, it is hard to turn on the TV today without seeing a commercial for gold or silver investments. Whether you agree or not with the ads, for millennia, individuals and governments have stored their wealth in precious metals. Benefits and risks of alternative investments. U17L07. Describe the benefits and risks of alternative investments. Most alternative investments share similar benefits and risks. Usually, these investments offer low or even negative correlation to the stock market, resulting in greater diversification of the portfolio. This can lead to greater overall long-term returns with reduced risk. In some cases, there are opportunities for abnormal returns, high and low. As was done with pooled investment vehicles in Unit 14, we'll take these one at a time. DPPs. The DPP investor enjoys several advantages, including an investment managed by others, flow-through of income and certain expenses, and limited liability. The most the investors can lose is the amount of their investment plus any funds committed for, but not yet remitted. The exam will probably give more attention to the following disadvantages. Liquidity risk. The greatest disadvantage is lack of liquidity. Because the secondary market for DPPs is limited, investors who want to sell their interests frequently cannot locate buyers. Legislative risk. When Congress changes tax laws, new rules can cause substantial damage to LPs, who may be locked into illiquid investments that lose previously assumed tax advantages. Unit 17. Unit 17 Alternative Investments and Other Assets 385. S65_LEM.INF 385 March 15, 2019, 10:58 and 51 seconds a.m. Risk of audit statistics from the IRS indicate that reporting ownership of a DPP results in a significantly higher percentage of returns selected for audit. Depreciation recapture. One of the tax benefits is the ability to depreciate most fixed assets, especially when that depreciation can be accelerated. The effect of the depreciation deduction is to lower the tax basis of the asset. If that asset is then sold for more than that basis, the excess is recaptured and subject to tax, possibly at ordinary income tax rates. You won't need to know anything more than the concept. Example 1. Benefits of investing in a DPP would include I. High liquidity 2. Flow-through of operating losses 3. Limited liability 4. Immunization against tax audit A. 1 and 2B. I and 4C, 2 and 3D, 3 and 4 answer. C. DPPs are structured as flow-through entities, giving their investors the opportunity to receive income without the partnership being taxed first. In addition, if there are losses, they get the opportunity to write off those losses against passive income from other DPPs. As limited partnership vehicles, they offer their investors liability limited to their investment. They generally have very low liquidity and, instead of reducing the tax audit risk, they increase it. Real estate investing offers several benefits. Historically, real estate has been a hedge against inflation. It provides rental income, a portion of which may be tax-advantaged due to depreciation and interest deductions. It offers high leverage. Real estate loans generally require a relatively small down payment. Investment real estate is not generally correlated with stock market returns. It offers Section 1031 tax-free exchanges. Investors should also be aware of some of the risks. In general, a lack of liquidity, certainly when compared to stocks, bonds, or mutual funds, is a risk. If purchased for rental, each month that the property is not rented is money lost. 386 Unit 17 Alternative Investments and Other Assets. S65_LEM.INV 386, March 15, 2019, 10:58 and 51 seconds a.m. High leverage can work against the investor in a down market. The individual just might not have the skills necessary to manage the property, and hiring someone else could eliminate or greatly reduce the profits. Any good asset allocation program should have real estate, but, other than owning your own home, at least for most investors, REITs are probably the preferred option. Example. 1. Among the reasons for investors to consider investing in real estate would be all of the following except F. The ability to increase returns through leverage. B. A high correlation with stock market returns. C. Possible tax advantages. D. Potential appreciation. Answer. B. One of the investment advantages of real estate is that returns are generally negatively correlated with those of the stock market. Option B. Benefits of investing in commodities. Potential hedge against inflation. One of the reasons for inflation is frequently an increase in the cost of basic commodities. During those periods, investors in those commodities should keep pace with or possibly exceed the inflation rate. However, investors should note that commodities can be much more volatile than other types of investments. Diversification. Commodities are generally not correlated with stock market returns. This negative correlation, see the next unit, offers diversification of returns, commodities up when stocks are down and the reverse, and can have the effect of reducing overall portfolio volatility. However, just as with any other assets, diversification does not ensure a profit or guarantee against loss. Potential returns. As with any other investment, those who buy low and sell high will make money, or the reverse if you take a short position. Commodity prices are subject to supply and demand on a global basis and can provide handsome returns to those who predict future shortages. Risks of commodity investing. Principal risk. Commodity prices can be extremely volatile, and the commodities industry can be significantly affected by world events, import controls, worldwide competition, government regulations, and economic conditions, all of which can have an impact on commodity prices. Because of the leverage involved in futures, investors can easily lose their entire investment virtually overnight. Volatility. Not only are the prices of the actual commodity volatile, but those investors seeking to lower their risk by investing in commodity mutual funds or ETFs will find that those vehicles reflect the volatility of the underlying commodity or index as well. This is especially so when the ETF or fund uses options or other derivatives. Exposure to foreign markets. In Unit 12, we discussed some of the risks of investing in foreign securities. Because commodities represent a global investment, in addition to Unit 17. Unit 17 Alternative Investments and Other Assets 387. S65_LEM.INV 387 March 15, 2019, 10:58 and 51 seconds a.m. The risks of the commodities themselves, there is also the vast array or risks that one faces when investing in foreign markets. Particularly prevalent here would be currency risk as well as the risks caused by political, economic, and currency instability. High cost. This risk applies primarily to investing in the actual precious metal. For the small to average investor, the spread between what you pay for the bullion or coins and what you can resell for is significantly higher than the markup or commissions on stock or futures contracts. Lack of income. No matter how long you hold gold or silver, you will never receive a dividend or an interest check. In fact, with any commodity, there is no income, only the chance for capital gains. Examples 1. An investor is reading a report that industrial demand for copper is expected to double in the next 5 years. This might lead the investor to A. Buy corn futures, B. Sell copper futures, C. Invest in several copper mining companies, D. Modify the investor's portfolio to take a larger cash position. Answer, C. If the demand for copper increases, those companies producing the commodity should find their stock prices increase nicely. Choice C. Selling copper futures would be when one expects the demand, and, therefore, prices, to fall. 2. Investors interested in adding precious metals to their portfolios would likely consider A. Coal, B. Diamonds, C. Gold, D. Tin. Answer, C. Of these choices, only gold, C. is considered a precious metal. Diamonds are certainly precious, but they are not a metal. Tin is a metal, but is not considered precious. 388, Unit 17, Alternative Investments and Other Assets. S65_LEM.INV 388, March 15, 2019, 10:58 and 51 seconds a.m. This unit consists of 7 units. Unit 18, Type of Client. Unit 19, Client Profile. Unit 20, Portfolio Management Styles, Strategies, and Techniques. Unit 21, Tax Considerations. Unit 22, Trading Securities. Unit 23, Performance Measures. Unit 24, Retirement Plans, including ERISA issues and educational funding programs. In total, there will be 39 questions on this material, representing 30% of the Series 65 exam. 4. Part. Client Investment. Recommendations and Strategies. 389. S65_LEM.INV 389, March 15, 2019, 10:58 and 52 seconds a.m. S65_LEM.INV 390, March 15, 2019, 10:58 and 52 seconds a.m. Generally, any competent person of majority age can open an account, and anyone declared legally incompetent cannot. Fiduciary or custodial accounts may be opened for minors or legally incompetent individuals. In addition to individuals, accounts may be opened for anyone else meeting the definition of a person. That would include business and government entities. Some of these would be considered institutional accounts as defined in Unit 1. The Series 65 exam will include 6 questions on the material covered in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U18-LO1, recognize the different types of client securities professional service. U18-LO2, identify the different ownership categories and the legal documentation required to open an account. U18-LO3, distinguish between the different kinds of business entities capable of opening accounts. U18-LO4, classify the special requirements for fiduciary accounts, including trust and estate accounts. U18-LO5, identify estate planning options. New account agreement. U18-LO1, recognize the different types of client securities professional service. Securities professionals can serve a wide variety of clients. They range from the individual client to sovereign governments and everything in between. In this unit, we'll cover accounts. 18. Unit. Type of client. 391. S65_LEM.INV 391, March 15, 2019, 10:58 and 52 seconds a.m. For natural persons, such as the various types of joint accounts. Accounts can be opened for all kinds of philanthropic endeavors, including charities and foundations. We'll also spend time describing the various types of business accounts. Even though any type of government unit from municipalities to states to countries can employ the services of broker-dealers and investment advisors, the exam does not deal with those relationships other than when a broker-dealer acts as an underwriter for political issuer. Account ownership categories. U18L02. Identify the different ownership categories and the legal documentation required to open an account. Individual account. An individual account may be for a natural person, a trust, or a deceased person through an estate account. There is one beneficial owner. When referring to investment advisors, normally an individual client is a natural person whose investments are managed by an advisor for a fee. When a business is organized as a sole proprietorship, that business account is also considered an individual account. The advisor should establish, in consultation with the client, a written statement of objectives and investment strategy before making recommendations to the client. This document is frequently referred to as an investment policy statement, IPS. In the next unit, we will examine the client profile and see the information necessary to prepare the IPS. In Unit 24, we will discuss the use of the IPS by those with fiduciary responsibility over qualified retirement plans. The advisor must periodically review the client's investment profile to determine whether any changes in circumstances could alter the client's objectives. Unless certain legal documents are procured, the account holder is the only person who can control the investments within the account or request distributions of cash or securities from the account. Suitability for individual accounts. Both federal and state regulations require that any investment recommendation be suitable based upon the client's needs, objectives, and financial considerations. In the next unit, we will look at a number of those issues. Joint accounts. A joint account is owned by two or more persons, and each is allowed control over the account. Generally, suitability information is required on all of the tenants in the account. On the new account form, the account must be designated as either tenants in common, TIC, joint tenants with right of survivorship, TROS, or tenants by the entirety. Account forms for joint accounts require the signatures of all owners. Trading activity, buying or selling, may be initiated at the request of any one of the parties. If a security is purchased and a certificate is issued, it must be in the name of all of the tenants. Furthermore, when that security is sold, all of the tenants must sign that certificate, or a stock or bond power. The 392 Unit 18 type of client. S65_LEM.INV 392 March 15, 2019, 10:58 and 52 seconds a.m. Check for the proceeds must be made payable to all of the tenants, and it will be sent to the address designated in the account documents. Tenants in common, TIC. TIC ownership, or JTIC, provides that a deceased tenant's fractional interest in the account is retained by that tenant's estate and is not passed to the surviving tenants. Ownership of a TIC account may be divided unequally. At the death of an account owner, that person's proportionate share of the cash and securities in the account is distributed according to the instructions in the decedent's will. Example: if a TIC agreement provides for 60% ownership interest by one owner and 40% ownership interest by the other, that fraction of the account would pass into the deceased owner's estate upon death. The TIC agreement may be used by more than two individuals. Joint tenants with right of survivorship, TROS. TROS ownership stipulates that a deceased tenant's interest in the account passes to the surviving tenants. Regardless of contributions, each TROS account owner has an equal and undivided interest in the cash and securities in the account. Upon the death or declaration of incompetency of any of the account owners, account ownership passes to the survivors, a right of succession occurs, and the other party or parties become sole owners of the account. Test topic alert. Whenever the test uses the term joint tenants, it means TROS, not tenants in common. Tenancy by the entirety, TBE. is the third type of concurrent ownership, or ownership by multiple persons. As with the other two we've described, each co-tenant has an undivided interest in the account. Unlike the other two we discussed, a tenancy by the entirety can be created only by married persons. The most important difference between a tenancy by the entirety and a TROS or TIC is that in this form of ownership, the consent of the other tenant is required before the other tenant can sell or give away his interest in the property. As with TROS, upon the death of one of the spouses, the deceased spouse's interest passes to the surviving spouse. Because this form of ownership is restricted to spouses, it is considered similar to the community property laws found in some states. Tenancy by the entirety is most commonly used for ownership of real property, real estate. Definition: undivided interest. In a joint account, all owners have an undivided interest in the account. What does that mean, especially when we see that TIC can have unequal shares? Simply stated, an undivided interest means that the no tenant has a designated interest in any specific asset in the account. Even when the shares are unequal, one tenant doesn't get stock A and the other stock B. Using Unit 18. Unit 18 type of client 393. S65_LEM.end 393 March 15, 2019, 10:58 and 52 seconds a.m. Our 60/40th example with the TIC account, one owner would have 60% of each of the holdings and the other 40% of each. The assets themselves are not divided between the owners. Test topic alert. Tenants in common can own unequal interests in the account, unlike joint tenants with right of survivorship, who always share equally. Tenants by the entirety are considered a single owner, no separate shares. TIC does not avoid probate. Checks or distributions must be made payable in the account name and endorsed by all parties. Examples. 1. A new account is opened for joint tenants with rights of survivorship. All of the following statements are true except A. Orders may be given by either party. B. Mail can be sent to either party with the permission of the other party. C. Checks can be drawn in the name of either party. D. In the event of death, the decedent's interest in the account goes to the other party. Answer. C. Although either party may enter an order, any money or securities delivered out of the account must be in the names of both owners. Choice C. Rights of survivorship means that the surviving owner, or owners, receive the deceased's interest in the account. 2. If three individuals have a tenants in common account with a firm and one individual dies, then A. The account must be liquidated and the proceeds split evenly among the two survivors and the decedent's estate. B. The two survivors continue as co-tenants with the decedent's estate. C. Probate is avoided on the estate of the deceased co-tenant. D. The account is converted to joint with rights of survivorship. Answer. B. In the case of a TIC account, the decedent's estate, choice B, becomes a tenant in common with the survivors. Suitability for joint accounts. The suitability requirements for a joint account follow the same basic rules as all accounts. You must have a reasonable basis to believe all recommendations presented are suitable based on the information gathered. Because a joint account is really nothing other than a collection of individuals, suitability information must be obtained on all of the account owners, and any recommendations must be appropriate based upon that information. An example you might see on the exam has two brothers with a TIC account. One brother is an accredited investor under Rule 501 of the Securities Act, while the other is far from it. In this case, suitability is usually based on the lowest common denominator, the non-accredited brother. 394, Unit 18 type of client. S65_LEM.end 394 March 15, 2019, 10:58 and 52 seconds a.m. Examples. 1. Several investors open an account in joint tenancy. For suitability purposes, financial information is required on which of the following investors? The majority of the investors. B. The largest investor only. C. Only the one authorized to trade the account. D. All of the investors. Answer. D. When a joint account is opened, to be able to make suitable recommendations, financial information should be obtained on all of the account owners. Choice D. 2. Which of the following individuals may not open a joint account? A. Two spouses. B. 3 sisters, C. 2 friends, D. A parent and a minor child, answer. D. A joint account may be opened by 2 or more individuals who have legal standing. A minor may not be a party in a joint account because minors are not legally considered a person. Think back to Unit 1. That makes choice D correct. A parent, or any other adult, can be custodian for a minor, but that is a single account, not a joint account. What are the legal requirements for opening up these various accounts? Opening an account for an individual requires the completion of the new account agreement. This is basically a contract between the broker-dealer or investment advisor and the customer explaining the rights and obligations of both and the charges for the services that will be rendered. Information that must be obtained from the client includes items such as legal capacity, that is the client of full legal age in the state or jurisdiction or residence, and does she have the capacity to enter into the agreement, employment information, and the Customer Identification Program, CIP, notice. To help the government fight the funding of terrorism and money laundering activities, broker-dealers and investment advisors are required by federal law, the USA Patriot Act, to obtain, verify, and record information that identifies each person who opens an account. Customer identification. Requirements apply to all customers opening a new account as those terms are defined in the Bank Secrecy Act. That information includes name, date of birth, permanent physical address, no mail receiving or incorporation services, tax identification number. If a U.S. citizen, this is typically the Social Security number, citizenship or visa details, and financial information about the client. Unit 18. Unit 18 type of client 395. S65_LEM.End 395 March 15, 2019, 10:58 and 52 seconds a.m. In the case of joint accounts, the information is the same except that details on all of the joint owners must be furnished. One of the joint owners is designated as the primary contact to receive statements and other communications. We have not heard anything about the exam requiring you to know the account opening details for business accounts, although there is plenty about those accounts tested that will be covered shortly. In Unit 16, we dealt with derivatives, especially options. There are some unique requirements to open those accounts. NSAA does not have a specific rule dealing with the opening of options accounts. Therefore, we will refer to the FINRA rules that are used as the guidelines for most states. Because trading options, puts and calls, generally involves a higher degree of risk than stocks, bonds, or mutual funds, a designated supervisory person with knowledge about options must approve the account opening. In addition, there is a special options disclosure document, ODD, that must be provided to any options customer at or prior to the time such customer's account is approved for options transactions. In approving a customer's account for options trading, a broker-dealer or agent associated with the broker-dealer must exercise due diligence to ascertain the essential facts relative to the customer, his financial situation, and his investment objectives. One question asked on a new options account form that is not required on a normal brokerage account opening is investment experience and knowledge, example, number of years, size, frequency, and type of transactions, for options, stocks and bonds, commodities, and other financial instruments. Based upon such information, the designated supervisory person shall specifically approve or disapprove in writing the customer's account for options trading. The account approval will indicate the date the options disclosure document, ODD, is furnished to the customer. Nature and types of transactions for which the account is approved, example, buying, covered writing, uncovered writing, spreading, and discretionary transactions. Name of the agent assigned to the account. Name of the supervisor approving the account. Date of approval, and dates of verification of currency of account information. Within 15 days after a customer's account has been approved for options trading, the broker-dealer must obtain from the customer a written agreement that the customer is aware of and agrees to be bound by FINRA rules applicable to the trading of option contracts, and that the customer has received a copy of the current ODD. Part of the agreement states that she is aware of and agrees to be bound by the rules of the Options Clearing Corporation. Finally, there are specific requirements for opening a margin account, and those will be covered in Unit 22. 396 Unit 18 Type of Client. S65_LEM.INF 396, March 15, 2019, 10:58 and 52 seconds a.m. Example 1. When an agent with a broker-dealer opens a new options account for a client, in which order must the following actions take place? I. Obtain approval from a qualified supervisor. 2. Obtain essential facts from the customer. 3. Obtain a signed options agreement. 4. Enter the initial order. A1, 2, 3, and 4B. 1, 2, 4, and 3C, 2, I, 4, and 3D, 2, I, 3, and 4 answer. See the steps in opening an options account occur in the following order. Obtain essential facts about the customer, give the customer an ODD, have the manager approve the account, enter the initial order, and have the customer sign and return the options agreement within 15 days. That is the sequence in choice C. Accounts for business entities. U18LO3, distinguish between the different kinds of business entities capable of opening accounts. Sole proprietorship, this is the simplest form of business organization and is treated like an individual account. Therefore, the same issues of suitability that apply to individual accounts apply to the management of sole proprietorship accounts. In a sole proprietorship, all income or loss is that of the individual. In fact, one of the risks of operating in this fashion is that all of the owner's assets are liable for the debts of the business. You can lose everything. Obviously, this is one of the major considerations when opening an account for this form of business. General partnership. A general partnership is an unincorporated association consisting of 2 or more individuals. In a general partnership, the partners manage and are responsible for the operation and debts of the business. Partnerships are easy to form and easy to dissolve, but are generally not suited for raising large sums of capital. Partnerships allow the business profits and losses to flow directly through to the investors for tax purposes, thus avoiding double taxation of profits at the business and individual levels. Because the income and losses flow through to the individual partners, an investment policy for a general partnership would have to consider the combined/collective objectives of all of the partners. Unit 18. Unit 18 Type of Client 397. S65_LEM.INF 397 March 15, 2019, 10:58 and 52 seconds a.m. Limited partnership. In the case of an enterprise organized as a limited partnership, the management and liability is assigned to the general partners while the limited partners are passive and have liability limited to their investment. This is the typical case with the direct participation programs, DPPs, discussed in Unit 17. Suitability decisions are similar to a general partnership except that the limited partners do not have the full liability of the general partners. Limited Liability Company, LLC. A limited liability company, LLC, is a business structure that combines benefits of incorporation, limited liability, with the tax advantages of a partnership, flow-through of taxable earnings or losses. The LLC owners are members, not shareholders, and are not personally liable for the debts of the LLC. Just as with the partnership clients described previously, the objectives and financial constraints of the individual members must be considered from a suitability standpoint. S Corporation. An S Corporation, although taxed like a partnership, offers investors the limited liability associated with corporations in general. The profits and losses are passed through directly to the shareholders in proportion to their ownership in the S Corporation. Unlike an LLC, which can have an unlimited number of members, an S Corporation may not have more than 100 shareholders, none of whom may be a non-resident alien, or more than one class of stock, presumably common. Losses on S Corporation stock may be claimed only to the extent of an investor's basis in the shares. The basis includes money contributed or lent to the corporation. Any business organization client where the entity itself has no liability and is not subject to tax, such as the partnerships, LLC, and S corporation, requires the advisor to look through the entity to the owners to properly meet the suitability standards. Take note. Geraldine invested $25,000 in an S corporation along with 9 other investors who invested the same amount. Within a year, the corporation needed additional equipment, so Geraldine lent $10,000 to the business from her own funds. Her basis is now $35,000. If the corporation experiences a $400,000 loss, Geraldine's portion is $40,000. However, she may deduct only $35,000 of the loss, because that is the amount of her basis. C corporation. A C corporation is a business structure that distinguishes the company as a separate entity from its owners. If a business expects to need significant capital, this form is almost always the preferred choice. Unlike the management of a partnership, the general partners, in most cases, the corporation's officers and directors are shielded from personal liability for the corporation's debts and losses. Shareholders are also shielded from corporate creditors. That is the limited liability benefit of owning stock. Corporate income tax applies to the corporation as an entity rather than being passed through to the shareholder. If your client is 398 Unit 18 type of client. S65_LEM.End 398 March 15, 2019, 10:58 and 53 seconds a.m. A C corporation, you will only look at the corporation's financial needs and objectives when determining suitability. Take note. C corporation earnings are subject to double taxation. Before distribution, the earnings are taxable to the corporation and then are taxed again to the shareholder when paid out as a dividend. Distributions from LLCs and S corporations are taxed only once because there is no taxation at the business entity level. Choosing the right business structure. Here are some testable points to consider when a person is considering the most appropriate business form to use. The easiest business to set up, especially if you don't expect much liability, is the sole proprietorship. However, because the business and the owner are inseparable, there is unlimited liability and no limits to the amount of the loss, if any, that may be claimed on the proprietor's tax return. Partnerships and LLCs are generally easier to form and dissolve than a C corporation. Benefits of structuring a business as a general partnership, an LLC, or an S corporation would include no double taxation as is the case with a C corporation. However, a company that expects to be very profitable should be a C corporation instead of a partnership, an LLC, or an S corporation because in those three, all earnings pass to owners, nothing can be retained. Only the sole proprietorship and the C corporation are taxed on their income. The sole proprietorships is on the owner's personal tax return and the corporation's is on a Form 1120. The only logical choice where a large amount of capital is to be raised is the C corporation. The business entities that have limited liability for owners as well as flow-through of income or loss are the limited partnership, LLC, and S corporation. The C corporation has limited liability but no flow-through. The sole proprietorship and general partnership have flow-through but unlimited liability. Corporations, including LLCs, survive the death of their owners, even if there is only one shareholder in an S corporation or C corporation, or one member of the LLC. When it comes to transferability of ownership, the corporate form, especially the C corporation, is the preferred choice. Selling shares is usually pretty straightforward. Unit 18. Unit 18 type of client 399. S65_LEM.End 399 March 15, 2019, 10:58 and 53 seconds a.m. Examples. 1. 3 friends plan to start a new business. It is anticipated it will be several years before the business turns a profit. Which of the following types of business organization would be best if they wish to limit their liability while, at the same time, being able to receive favorable tax treatment for the expected losses? A C corporation B, S corporation C, general partnership D, sole proprietorship. Answer, B. The only way to limit liability is through a corporation, or LLC or limited partnership, neither of which is offered here as a choice. The S corporation allows for the flow-through of operating losses to the shareholders, while the C corporation does not. 2. Which of the following business structures is most appropriate for retaining money in the business? A C corporation, B. A sole proprietorship, C. An LLC, D. An S corporation, answer, A. Only in the case of a C corporation, choice A, is money retained not subject to tax on the personal level. In all of the other choices, any income is passed through to the owners, making it inefficient to accumulate funds in the business. Fiduciary accounts. U18LO4, classify the special requirements for fiduciary accounts, including trust and estate accounts. In a fiduciary account, the individual granted fiduciary responsibility enters trades for the account, makes all of the investment, management, and distribution decisions, and must manage the account in the owner's best interests. Examples of fiduciaries include the following: trustee designated to administer a trust executor, F. executrix, designated in a decedent's will to manage the estate's affairs, administrator appointed by the courts to liquidate the estate of a person who died intestate, without a will, known as an administrator or trustee in intestacy, guardian, conservator, designated by the courts to handle the affairs of a minors or a person judged incompetent, custodian of in uniform. Transfer to Minors Act, UTMA, account receiver or trustee in a bankruptcy. 400 Unit 18 type of client. S65_LEM.in 400 March 15, 2019, 10:58 and 53 seconds a.m. A fiduciary is anyone legally appointed and authorized to represent another person, act on that person's behalf, and make decisions necessary to the prudent management of that person's account. The constraints placed on the actions of a fiduciary are described in detail in the Uniform Prudent Investors Act, UPIA. For example, a fiduciary cannot use account contents for personal benefit but may be reimbursed for reasonable expenses incurred in managing the account. Do not confuse that with transaction costs. When determining appropriate investments, the cost of the transaction, trading commissions, is not nearly as important as how well the investment meets the needs of the account. The exam tends to focus its UPIA questions on those managing qualified retirement plans, so we'll revisit the Act in Unit 24. Take note. Any trades the fiduciary enters must be consistent with the trust's investment objectives. Opening a fiduciary account. Opening a fiduciary account may require a court certification of the individual's appointment and authority. An account for a trustee must include a trust agreement detailing the limitations placed on the fiduciary. No documentation of custodial rights or court certification is required for an individual to open an UGMA or UTMA account. See Unit 24. Power of attorney. If the person who is not named on an account is to have trading authority, the customer must file written authorization with the broker-dealer giving that person access to the account. Without this power in writing, no matter how tempting the answer on the exam, activity in the account cannot be created by anyone other than the account owners. Trading authorization usually takes the form of a power of attorney. Two basic types of trading authorizations are full and limited powers of attorney. Full power of attorney. A full power of attorney allows an individual who is not the owner of an account to deposit or withdraw cash or securities, and/or make investment decisions for the account owner. Limited power of attorney. A limited power of attorney allows an individual to have some, but not total, control over an account. The document specifies the level of access the person may exercise. Test topic alert. Limited power of attorney, also called limited trading authorization, allows entering of buy and sell orders, but not the withdrawal of funds. Entry of orders and withdrawal of funds is only allowed if full power of attorney is granted. Unit 18. Unit 18 type of client 401. S65_LEM.in 401 March 15, 2019, 10:58 and 53 seconds a.m. Durable power of attorney. or limited power may be made durable by the grantor of the power. It is designed to provide that a specifically designated person maintains power over the account even upon the grantor's incapacitation, whether due to physical or mental causes. Its most common use is when providing for aging parents. However, upon the death of either principal to the durable power of attorney, the power is terminated. How does this differ from the living will we will discuss shortly. A living will is a written document making your specific end-of-life wishes known. The durable power of attorney, POA, appoints someone to act on your behalf and make the decisions. So, if you want to be sure your wishes, such as organ donation, are followed, prepare a living will. Test topic alert. A durable power of attorney survives the physical or mental incompetence of the grantor, but not the death of either party. This means that orders entered after the time of death of the grantor, even if the purchase or sale was decided upon before death, are not accepted. Trust and estate accounts. Two special kinds of accounts that may appear on the exam are those dealing with trusts and estates. What both of these have in common is that the person entering orders on behalf of the account is acting in a fiduciary capacity, whether it be the trustee of the trust or the executor or administrator of the estate. These fiduciaries are acting for the benefit of the beneficiary or beneficiaries of the trust or estate, so it is necessary to look at the objectives of the trust and the needs of the heirs. Trust accounts. A trust is a legal entity that offers flexibility to an individual who wishes to transfer property. Trusts may be established for a variety of personal and charitable property transfers. Trusts are also established as a legal entity for a corporate retirement plan, but that will be covered in a later unit. The subject of trust law is very complicated and should only be addressed by one who is competent in the subject, usually an attorney. This exam will require you to know the basics of trusts, how trusts are taxed, trustee responsibility, and your obligations when acting as an advisor to the account. Trust parties. For a trust to be valid, 3 parties must be specified in the trust document, trust agreement. These parties are a settlor, a trustee, and a beneficiary. Under certain circumstances, the settlor, trustee, and beneficiary may be the same individual. For a trust to be valid, both the settlor and the trustee must be competent parties. However, the beneficiary may be a minor or a legally incompetent adult. 402 Unit 18 Type of Client. S65_LEM.IN 402 March 15, 2019, 10:58 and 53 seconds a.m. The settlor. The settlor is the person who supplies the property for the trust. Trust property is also referred to as its principal or corpus. This party is also known as the maker, grantor, trustor, or donor. Trustee. A trustee is an individual or other party holding legal title to property held for the benefit of another person or persons. The trustee must administer the trust by following directions in a trust agreement or in a will. A trustee must perform certain duties relative to the trust. Property. A trustee is a fiduciary and is obliged to perform in the interest of the beneficiaries. The trustee may be one or more adult individuals or an entity in the business of trusteeship that is responsible for investing, administering, and distributing trust assets for benefit of the beneficiary or beneficiaries. In many ways, a trustee's duties are like those of an executor for an estate. However, a trustee's duties generally continue for more time than a typical estate settlement, and the trustee is charged with the greater duty of investing trust assets. Beneficiary. A beneficiary is a person for whose benefit property is held in trust. A beneficiary is one who receives or who is designated to receive benefits from property transferred by a trustor. Beneficiaries to a trust include only those persons upon whom the settlor intended to benefit from the trust property or those who would succeed their interests. Example. Jill establishes a trust under which her husband, Julian, is to receive all income produced by the trust property for as long as he lives. Upon Julian's death, their daughter, Janet, will receive the trust principal. Julian is a primary beneficiary. However, until Julian's death, Janet is a contingent beneficiary because her benefit depends on the occurrence of an event, in this case, Julian's death. Test topic alert. Although it doesn't happen often, the grantor of the trust can also be the trustee and/or the beneficiary. Remainder man. When the trust has run its course and all expenses and distributions have been made, the person who receives the remaining balance is called the remainder man. No gender preference here. There's no such term as remainder woman. The most common case involves real estate. For example, the husband dies and has arranged for his wife to have full use of their home until she passes away. At that time, any surviving children inherit the home. They are the remainder men. Unit 18. Unit 18 type of client 403. S65_LEM.IN 403 March 15, 2019, 10:58 and 53 seconds AM. Simple trusts versus complex. Simple trusts. All income earned on assets placed into a simple trust must be distributed during the year it is received. If the trust does not distribute all of its net income at least annually, the trust is declared a complex trust. The trustee is not empowered to distribute the trust principal from a simple trust. Complex trust. On the other hand, a complex trust may accumulate income. A complex trust is permitted deductions for distributions of net income or principal. Capital gains are deemed part of the distributable net income of a complex trust unless reinvested. Furthermore, the trustee may distribute trust principal according to trust terms. We'll have more to say about these in Unit 21. Test topic alert. The key difference between a simple and a complex trust is that the simple trust must distribute all of its annual income, whereas a complex trust is not obligated to do so. Living versus testamentary trusts. Living trust. A living trust, also known as an inter vivos trust, is established during the maker's lifetime. When an individual sets up a revocable living trust, she maintains complete control over it. During the maker's lifetime, she can make changes to the trust as often as she wants to and can add or remove assets as desired. These trusts contain instructions for managing the trust upon the incapacity or death of the grantor. Testamentary trust. With a testamentary trust, the settlor retains control over assets until death. Think last will and testament. The individuals will stipulate that, at death, the testator's property is to be placed in trust for the benefit of one or more beneficiaries. The testamentary trust does not reduce the grantor's income or estate tax exposure. Furthermore, assets that pass to a testamentary trust do not avoid probate because the validity of the will's instructions to pass property to the trust must be substantiated in probate court. Living will. Please do not confuse a living will with a living trust or even a will. The common name for these is an advance directive of medical care directive. This has nothing to do with assets or beneficiaries. It is the individual's instructions for end-of-life situations, such as withholding medical care or organ donation. The exam may show it something like this. 404, Unit 18, type of client. S65_LEM.IN 404 March 15, 2019, 10:58 and 53 seconds AM. Example. 1. A living will is used to avoid the cost and time of probate being eliminated, or at least reduce, estate taxes. C. Ensure that the author's assets are properly distributed after death. D. Express the author's end-of-life wishes. Answer. D. Sometimes referred to as a medical directive or advanced care directive. A living will is used to express the author's end-of-life wishes, such as organ donation, pulling the plug, and so forth. Choice D. It has nothing to do with living trust or a last will and testament describing the distribution of assets after death. Foundations and charities. One of the discoveries of the Madoff affair was the large amounts lost by charities and foundations. In most cases, certainly true for charities, they should be dealt with as the fiduciary accounts described previously. In the case of foundations, because those are usually funded by the principals, a greater amount of investment flexibility may be called for. Philanthropic funds, wealthy individuals may set up donor-advised funds that allow for flexibility and tax advantages. There are mutual fund sponsors and banks that offer these individuals the opportunity to donate a lump sum, take a current tax deduction, and then have the assets invested to earn over a period while allowing the donor to advise distributions to favored charities. If you are dealing with high net worth clients who are of a charitable bent, there could be great merit in advising them in this direction. Example 1. For which of the following types of clients would the suitability requirements be somewhat more relaxed? A. A guardian for an orphan. B. A charity. C. A foundation. D. An executor. Answer. C. Guardians and executors are fiduciaries controlling assets of those who cannot speak for themselves. Charities raise funds from donors expecting that the money will be invested wisely. Foundations, choice C, are generally funded by their founders who usually give those managing the money greater flexibility. Impact investments. Impact investing can be defined as the intentional allocation of capital to generate a positive social or environmental impact that can be, and is, measured. Unit 18. Unit 18, Type of Client 405. S65_LEM.IN 405, March 15, 2019, 10:58 and 54 seconds a.m. Charities and foundations usually have a specified goal, whether it be medical research, think American Cancer Society, or social goals, think Greenpeace. Impact investing is when the entity commits a portion of its funds to those companies or industries which align with those goals. I don't think the Cancer Society would have tobacco stocks in its portfolio, and Greenpeace probably wouldn't invest in strip mining companies. Impact investing is a subset of socially responsible investing, SRI, that attempts to generate positive social good in addition to the goals typically outlined in an SRI approach. Where SRI fund managers are generally passive and adopt a do-no-harm approach, impact investing funds typically not only seek to create positive impact, but measure and report their impact in a transparent way. The acronym ESG is also frequently found. This stands for environment, social, and corporate governance. Example 1. A socially responsible mutual fund would probably invest in companies. A. Generating high returns. B. Acting with high ethics and morality. C. Located in a single geographic area. D. With a major presence on social media. Answer. B. SRI looks for companies with high ethical standards, choice B. Here is a bit more about the topic, which should enable any student encountering this, or a similar question, to be confident in their choice of answer. The standards involved include corporate responsibility and concerns for society as valid parts of investment decisions. ESG criteria are used in an attempt to generate long-term competitive financial returns and positive societal impact. Program-related investments. Although somewhat similar to impact investing, program-related investments are those where the foundation, more common for them than charities, makes a charitable distribution. Examples of this would be helping bring new drugs to market more quickly by providing necessary funding. One caution is that the investments must be consistent with the philanthropy's mission to get the same favorable tax treatment by the IRS as a regular charitable gift would. Management obligations. In general, these foundations are managed by a board of directors having the responsibility of selecting and overseeing the activities of the investment manager. The board prepares an investment policy statement, IPS, describing their goals and objectives and uses this IPS to monitor how well the investment managers adhere to the plan. As described in the specific IPS, these managers need to evaluate the expected returns and see that they outpace inflation without taking undue risk. Diversification is a key, both with the types of industry, types of security, and relative risk. A special investment constraint applies to most private foundations. IRS regulations require a private foundation pay out each year an amount equal to 5% of its net investment assets in qualifying distributions. 406, Unit 18, Type of Client. S65_LEM.IN 406 March 15, 2019, 10:58 and 54 seconds a.m. Account opening requirements. Opening an account for an organization is somewhat more complicated than an individual account. In addition to information about the entity, detailed information about those individuals in a control position, officers, 10% owners, etc., must be supplied. Significant financial information about the organization is also required to help determine suitability. Most broker-dealers have special account opening forms, and investments advisors usually use a different contract when dealing with an organization. We don't expect you will see much in the way of detail on your exam. Estate planning options. U18L05, identify estate planning options. Although estate planning is best left for the specialists, the exam will cover several basic concepts which will enable you to assist your clients and help identify when to call in the attorneys. Transfer on death, TOD, accounts. Using a transfer on death, TOD, account is the simplest way to keep assets held in brokerage accounts from becoming subject to probate upon a client's death and, at the same time, be distributed specifically as the account owner wishes. However, the TOD account does not avoid estate taxes if applicable. TOD accounts are available for most types of paper assets, such as savings and checking accounts in banks and credit unions, certificates of deposit, stocks, bonds, and other securities. The owner, while alive, is the only person with any rights to the property. Upon the owner's death, the property is immediately transferred to the named beneficiaries, usually without any added cost. The owner has the right to change beneficiaries at any time and provide for unequal distribution of the assets if desired. One of the other attractive features of TOD accounts is that there is no legal documentation necessary. The only types of accounts that may be opened with a TOD designation are individual accounts, TROs, and tenants by the entirety accounts. Example. 1. A client has an account where, upon her death, she desires that her only son will receive 50% of account value and her 4 daughters will receive 12.5% each. The easiest way to accomplish this would be to title the account A. TOD, B. JUTROs, C. Tenants in common, D. In trust for the children. Answer. A. Transfer on death, TOD, choice A, requires no additional legal work and allows the account owner to designate beneficiaries in whatever percentages she wants. Furthermore, changes can be made at any time before death. Unit 18. Unit 18, type of client 407. S65_LEM.IN 407 March 15, 2019, 10:58 and 54 seconds a.m. Take note. You might also see this as payable on death, POD, although the term is used far more frequently for bank accounts. Taunton Trust. If you have a really old bank account, you might have a Taunton Trust designation using language similar to John Doe, in trust for Jane Doe, or perhaps John Doe as trustee for Jane Doe. Taunton Trusts, sometimes referred to as a poor man's will, allowed for the transfer of ownership of a bank account to a beneficiary after the owner's death. Taunton Trusts were the predecessor to POD or TOD designations, but a few states still recognize them. Revocable versus irrevocable trusts. For more elaborate estate planning, it is advised that the client consider the use of trusts. Terms of a revocable trust may be changed during the maker's lifetime. Terms of an irrevocable trust generally cannot be changed. Revocable trust. If the grantor retains the ability to revoke the trust and take back the trust assets, the trust is revocable, and the income is taxable to the grantor under the grantor trust rules. That means the grantor is subject to tax on trust income even when not receiving the income. Assets in a revocable trust are included in the grantor's gross estate for federal estate tax purposes. No estate tax benefits apply. Revocable trusts are also called living trusts. They are used primarily as a will substitute. Assets in trust avoid the cost, time, expense, and publicity of probate. Irrevocable trust. For a trust to be considered irrevocable, the settlor must give up all ownership in property transferred into the trust. Property placed in an irrevocable trust is usually not includable in the trustor's estate for federal estate tax purposes. Certain exceptions to the general rule can jeopardize the effectiveness of an irrevocable trust to reduce estate taxes, but are unlikely to be tested. Grantor Retained Annuity Trusts, GRATs. This is an estate planning tool designed to pass assets to beneficiaries, usually children, in a way to minimize gift and/or estate taxes. The topic is very complicated, but here are the basics you might need to know. The key is in the words, grantor retained. That tells you that any income from the trust is taxed to the grantor. The annuity portion is paid for a specified number of years. At the end of that term, the beneficiaries get whatever is left, and that could be free of estate and gift taxes. 408, Unit 18, Type of Client. S65_LEM.IND 408, March 15, 2019, 10:58 and 54 seconds a.m. Example. 1. Sam Jones has been a successful businessman and is concerned that his youngest daughter will not be able to live within her means. To protect this from happening, Jones places a large sum of money into a trust for the benefit of the daughter. Because Jones knows he won't live forever, he arranges for the Fourth Fidelity Bank and Trust Company to have control over the assets. Which of the following statements is not true? A. Sam Jones is the grantor. B. Sam Jones is the trustee. C. Fidelity Bank and Trust Company is the trustee. D. Sam Jones's daughter is the beneficiary. Answer. B. The person, A, who funds the trust is the grantor or settlor. The bank has been appointed to be trustee, C, and the daughter is the beneficiary, D, of the trust. That makes choice B the untrue statement. Estate accounts. An estate account is an account that, like a trust account, is directed by fiduciary on behalf of the beneficiary or beneficiaries of an estate. In the case of one who prepares a will, there is a specified executor. In the case of one who dies without a will, intestate, these functions are performed by a court-appointed administrator. The executor or administrator makes the investment, management, and distribution decisions for the account. Per stirpes. One common way for people to provide for their descendants is to incorporate the phrase, to my living issue, per stirpes in their will. In fact, some states automatically distribute in that fashion when one dies intestate. Per stirpes, not a typo, it is not stripes, is from a Latin word meaning branch. When used, per stirpes means that the deceased intended that a beneficiary's share of the inheritance is to go to an heir. Example. A widow or widower had 3 children and wished the estate to be distributed equally. If one of those children died prior to the estate settlement, that child's children, the grandchildren of the widow or widower, would share their parents' 1/3 share, receiving 1/6 of the total each, while the 2 living children would each receive a 1/3 share. It would look like this. Child A, child B, child C, deceased. Grandchild 1 and 2 1/3 1/3 1/6 th and 1/6 th. Per capita. Another Latin term, and this one means by total head count. Let's take the example used previously, where the deceased left the estate to 3 children. If they are all alive, simple. Unit 18. Unit 18, Type of Client 409. S65_LEM.IND 409, March 15, 2019, 10:58 and 54 seconds a.m. Enough, each inherits 1/3. But, if one of the 3 children, such as C in the previous example, has predeceased the parent and has 2 children, then the estate is split 4 ways, child A, child B, and the 2 grandchildren each receive 1/4 of the estate. Take note. Some states have differing rules for per capita distributions, making it unlikely the topic will be tested. Trust suitability issues. Just as with any other account, recommendations must be suitable when considering all of the relevant information. However, in the case of a trust or estate, there are several considerations that do not arise in other individual accounts. Some of these are as follows. In virtually all cases, the trust document declares the objectives of the trust. Generally, these can only be changed by the grantor or, once in receipt of the assets, the beneficiary. The trustee is obligated to invest the funds in accordance with those objectives. For example, if the objective is income until the death of the grantor, then that is the primary consideration in any recommended transaction. Always follow the terms of the trust. Unless specifically stated in the trust document, margin trading is not permitted. In the case of an estate,